Off. Welcome everyone, and thank you for joining us. My name is Lori Lucas, and good morning everyone. Let's go ahead and get started. Thank you. There's always someone in the crowd that knows how to whistle, so thank you. Good morning everyone. My name is Lori Lucas, and I'm the President and CEO of the Employee Benefit Research Institute. Welcome everyone to today's Policy Forum. It is our 85th Policy Forum. As you know, EBRI's mission is to bring unbiased, fact-based research to the employee benefits area for the benefit of policymakers, employers, members of EBRI, and the general industry to make better decisions about benefits. And I want to talk about the intersection that we find today in our policy forum between data, analysis, and interpretation. So there's a very famous book called The Visual Display of Quantitative Information, which is kind of an iconic book about how to position information in a way that has desired outcomes and really conveys meaning in a way that gets across data effectively. It was written by Edward Tufte, and he posits that better representation of the relationship between O-ring damage and temperature could have saved the Space Shuttle Challenger. So this is his way of demonstrating the importance of conveying information in a way that visually gives you access to it so you can analyze it appropriately and interpret it accurately. So the NASA engineers saw the following table when they were trying to evaluate whether it was safe to launch the Space Shuttle Challenger on a cold day. And there's you can see there's a row that says, or a column that says temperature, and then it shows damage to the O-rings. And they have all this data at their fingertips, and it wasn't conveyed in a way that really got across the point that on a cold day, there would be significantly more damage to the O-rings than on a warm day, and that was incredibly important information to have. So Tufte says, if they'd only seen the following chart, they could have understood what that table failed to convey. That on a day that was where the temperature was below 66 degrees, there was a very high chance a lot of O-rings would fail, and that would result in tremendous damage and, unfortunately, the accident that took place. So this gives you a sense of how it's important not only to have data, but to interpret it and analyze it effectively. And that's really what we're seeking to do with policy forums like today. EBRI does a lot of research, and we provide unbiased, fact-based research through issue briefs, through fast facts, infographics, PowerPoints, a lot of different ways, and also webinars. But in policy forums like today, what we're really trying to do is help not only show the analysis of our data, but bring you interpretation of it so that you can use it effectively as you make decisions around healthcare, financial well-being, and retirement. So as I said, we have a very jam-packed day today, and before I turn it over to our Master of Ceremonies, Michael Dozier, who is also the Vice Chair of the Public Policy Advisory Council at EBRI, I want to just have a couple announcements. First of all, I want to thank the International Foundation of Employee Benefits Plans for streaming this policy forum, which they partnered with us for many years and done. And we will be live streamed, and this will be posted on our EBRI website afterwards if any of your colleagues would like to view it. We have microphones situated throughout the room, and when you ask questions in view of the fact that we're live streaming, please ask your questions into the microphone so everyone on the live stream can hear as well. We do want to have this interactive, but we will hold questions to the end of each session. The presentations are online, so if you go to the EBRI website, and we have internet access posted all over the room, all of the presentations are online. Just go to the EBRI website, to the policy forum section, go to the agenda, and the links will provide all of the presentations. And with that, I believe all of my housekeeping is done, and I will turn it over to Michael Dozier to kick us off.
Thank you, Lori. All right, let me go back. I believe we had it a little bit out of order here. So let me take you through today's agenda. First, thank you all for coming. Thinking about this last night, it seems like a subtlety, but actually it feels fairly profound to me after I think about it some more. And the comment I'd like to make is, I know many of us in our day jobs get called into different forums, policy-centric, marketing-centric, sales-centric. You travel around a lot, and you get a lot of chance to, kind of hear people speak and see some of these informational opportunities. This is a different one from the ones that I've experienced, and that's why I'm so passionate about supporting EBRI. You'll notice in the way we set the agenda up today and structured it that there's kind of a three-part approach to almost every topic we take, and center to those three pieces is research, mostly done by the EBRI organization. Sometimes you'll see some stuff brought in from the outside, but that depth of analysis and the history, you heard Lori talk about the 85th Policy Forum, and the organization's been around for 40 plus years. There's a lot of depth of understanding that comes from that analysis that I don't think you can find in many places, if anywhere else. And so grounding everything on that kind of one anchor of that research driven by this deeply experienced organization, then we try to bring in a couple of other perspectives. Hopefully something very practical in the market, how things are going, how things are working well or not working well. And then any other kind of thought leadership perspective, whether it's a product development thought leadership or it's some kind of service in the marketplace, a vendor or a provider of sorts. You'll notice that almost all of the agenda items, except for our keynote speaker at the end, are constructed that way. And that's purposeful and thoughtful. So hopefully you will find, walking out of here, you might have some interesting nuggets of data that you didn't know before. They probably exist somewhere on the EBRI website. There is so much research, but we're trying to find those real key ones and highlight it. That's hopefully one aha moment you'll have in each of these. And then the other is listening to practitioners out in the marketplace trying to either deploy the thing we're researching or talking about kind of the operational highs and lows. So maybe there's some real practical learnings there too. So just wanted to say that. It felt like something that I had just been thinking about a lot lately, and it hit me last night. So after I get out of the way here, we're going to do 3 panels, which is again also our normal approach. We're going to try to hit all of the topic areas that are the centers of excellence of EBRI. So we'll start out, we're going to talk on the retirement side. We'll then move into some healthcare conversations, and then we'll get into financial wellness, and then I'll mention later our keynote speaker at the end. It's going to be really insightful and very much not in the here today kind of analytic mode of thinking, but more about what's possible on the horizon 5, 10, 15 years from now, and how might the employee benefits industry change, and I think most of us would argue could change dramatically. So that's the layout of the agenda. Please, again, be active in your questions. Make sure you get to the microphones. We've got a fair number of people on the live stream. Let's make this as interactive and dynamic as we can. As I intro, if my first group would want to start coming up, I'll give a little bit of a background here. We're going to have Mr. Andrew Schreiner from Fidelity moderate a panel of 3. Jack Vanderheide, Director of Research from EBRI, Bob Holcomb, who runs Legislative and Regulatory Affairs for Empower Retirement, and Amy Dyson, who's the VP of Retail Retirement Plans with Ameriprise Financial. What we're going to do is kind of a two-parter here. We're going to start with Jack. Jack was asked to look at the major policy proposals that are on the docket today and look at his retirement security model, projection model, and look and see what the potential implications are of all those major components, whether it's the changing of the MRD ages, whether it's talking about open MEPs. We've got a fairly deep view, as we would expect from Jack, on several items there. And then after Jack sets the stage with that data, then we'll go through a discussion from some of the practitioners about what they're seeing, kind of a thought leadership view of what's going on in the public policy arena out in the world that we live in today. So, Andy, I'll hand it over to you.
Can everybody hear me? How's everyone doing this morning? Good? I'm from Boston, and any place that is over 50 degrees is a good place to be, so happy to be here. I'm just going to give a quick introduction and ask Bob and Amy and Jack to give a little personal background, and then Jack will walk through the retirement security projection model and the different, some of the different legislative provisions that we're facing right now in RISA and the Secure Act. So a little bit of background on myself. Right now, my current title is SVP of DC Innovation That's defined contribution innovation, not Washington, D.C., although that would be interesting too. That's a recent change for me. I spent the past decade plus leading Fidelity's public policy efforts. So now I'm leading a team of folks who are looking into things like MEPS, emergency savings and the like, and thinking about that from a product side. So that's the background that I bring to this. When I was thinking about it yesterday, when I joined Fidelity, it was August of 2006. Mike was there with me. It was right after the Pension Protection Act passed. And one of the first things I worked on was a brochure to our clients outlining for them all the different great aspects of the Pension Protection Act. And it's fascinating just how fast time goes, but also how slow it takes to get legislation moving and passed. And I hope we're finally reaching the time which we're going to get another monumental bill passed at some point this year. So I'm excited for that and excited to talk to you all today about some of the provisions. So I'm going to kick it over to Bob, Amy, and Jack just to give a quick bio, and then Jack, you can walk through some of your interesting research.
Well, thank you, Andrew. My name is Bob Holcomb, and I head up the Legislative Regulatory Affairs Department for Empower Retirement. I've been in the industry, you mentioned coming in around PPA. You can always tell a true ERISA nerd because they pegged the time that they first started working in the industry with whatever was the major piece of tax legislation that might have happened. I came in just in time for the provisions of TRA 86 to start becoming effective. So I've been here, been in the industry for a little bit. But, as with Andrew or Andy, we are very excited about some of the things that we're seeing in Congress right now and, hopefully get some major pension reform soon.
And thank you, Andy. My name is Amy Deason. I work at Ameriprise Financial as the Vice President of Retail Retirement Plans. And what I do is I head up the product development group there for all retirement plans, whether it's the 401k, 403b, or IRA side of the business. I have been focused on retirement planning for the last 25 years, but in a lot of different capacities. I've worked with sales, I've worked in the marketing department, our mutual fund department, and most recently our product development department. And I have a lot of passion around this topic. I think this is a really exciting time for us. People need to save for retirement. They need to save more. It's part of our role in the industry in helping them. And I think this is just a great time to really start helping individuals do a better job for themselves and really understand what's available to them. Jack?
Thank you. I'm Jack Vanderheim, the Research Director at EBRI. I've been here 31 years now this month, and I can't tell you how excited I am to finally be in a situation where we not only have the kind of databases we put together with ICI, for example, on the 401k side, but have all the different elements we need, largely through cooperation of our members, to put together models that are going to hopefully be instructive in terms of legislative proposals. So I'm very much looking forward to today's conversation.
Thanks, Jack. And so, Jack, you can take us through some of the recent research that you and team have done.
Okay. So what I'm going to try to do very quickly in 15 minutes is go through a number of the most important proposals. As Michael mentioned, with PPAC, we meet on a regular basis, try to figure out what are the most important elements of different legislative proposals that are out there, and take a look at what the likely impact is. I should mention up front, this is not necessarily a complete analysis of any of the legislative proposals Andy mentioned. It's not a complete analysis of Automatic Retirement Plan Act. We still have some additional elements we're working on, for example, enhanced savers credit, but we're certainly expecting that later this month we will have an issue brief out that will hopefully put all this together for you. Very quickly, as far as the outline, I want to go through very quickly a background on the model that we're going to be using, the retirement security projection model. The reason I think it's important to spend at least a couple minutes, this is very much unlike many of the other models you see around town. This is not a replacement ratio model, for example. We actually look at the full decumulation phase and figure out basically what's the probability of having a successful retirement. I'll define that for you in a couple seconds. After I do that, I'm going to just give you some quick baselines to look at what average retirement deficits are by age, with and without Social Security reductions. Very quickly look at some of the average retirement deficits by age and future eligibility for DC plans. And the reason I'm going to spend some time on that slide, because I think it's going to be very, very clear after looking at that slide why so much of the conversation in terms of retirement income adequacy revolves around increasing coverage, increasing access. So hopefully that'll be clear. Then as far as the components I'm going to model for today's presentation, I'm going to have one slide, hard to believe, on plan coverage and enhancements. It's going to look at mandatory coverage for all employers except the very smallest. And the assumption is going to be those that basically end up with new plans that don't have them currently are all coming in as auto IRAs. We're doing sensitivity analysis around that, but just for the baseline today, that's what I'm going to start with. I'm going to also show very quickly what's the impact of increasing the auto escalation limit from 10 to 15%. Under ARPA, for example, it starts at 6, escalates to 10. We're going to show the impact of going up to 15. Going to show the impact of including part-time employees as far as the overall retirement income adequacy. And then I'm sure we've all heard this over and over and over. One of the biggest problems with today's system still is that of leakage, and try to show as a plan enhancement what would happen if we had full auto portability. Now, this is not necessarily tied to any particular product that's out there. This is just basically saying if every time somebody leaves a job before they retire, if those account balances could basically be held in some kind of clearinghouse until they end up with another employer and then rolled over. Basically, if you can eliminate leakages, how much of a difference is that going to make? Then we're going to go very quickly on a slide on what would happen if we had the guaranteed income for life element that's been talked about in several of the proposals. As was mentioned, I'm going to spend a little time on open MEPs. And then very, very quickly, we'll have something on required minimum distributions. Because of the way our model is defined, I'm not going to be able to show you how that's going to impact on retirement income adequacy. I think hopefully that'll be clear in a couple seconds, but at least show you if something like this was enacted, at least in the short term, how much difference it would have in terms of the distributions, and then end this with some key takeaways. There's a lot of material in the appendix I'm not going to have time to go through. If you want more detail on how the model works, etc., some of the other breakouts, that should be in there for you. So, the model. This is something Craig Copeland and I did back in the late 90s. In essence, Millbank Memorial Fund came to us and said many of the governors were very paranoid that they had no idea what they were looking at in terms of future generations of retirees and when they would become financially indigent. And if they became financially indigent, the governors would be on the hook for things like Medicaid, for their nursing home costs, etc. So we did one for Oregon, we did one for Kansas, we did one for Massachusetts, and before my previous boss asked me to do the other 47 states, we just went ahead and combined it all into one big national retirement income model. Two phases. In the accumulation phase, we basically look at everybody from 35 to 64. We can go younger if you absolutely need to, but there is much more standard error for the young individuals. We look at DC, DB, IRA, Social Security, and net housing equity. Basically, we're very, very lucky because of the work we do with ICI. We have the world's largest 401k database, so I can get all the behavioral assumptions I need, for example. We've got over 27 million employees and 110,000 plans. These linked records go all the way back to 96. We also have an IRA database that Craig administers with 25 million accounts, 20 million unique individuals. So basically, we get everybody out to retirement age. We're going to baseline at 65 for today, but we can certainly change that. Then, unlike many of the other models, we have a retirement phase. We just don't get you to 65, say, here's your replacement rate, is it bigger or less than a particular ad hoc threshold. We take 1,000 simulated life paths for each household starting at 65. And we do two kind of costs. The ones that are easy to figure out, the deterministic costs, food, apparel, transportation, etc. We can get a pretty good handle on that just from government data. But the one that I think is the most important for overall financial plan and retirement, you want to look at longevity risk. You want to look at long-term care risk. You want to look at post-retirement investment risk. So basically we have this massive simulation model that takes all that into account. What do we end up with? Well, for each of the 1,000 life paths for each household, sometimes you run short of money and sometimes you don't. If you want the technical definition, it's in the appendix. We do two different types of measures here. It's on the very bottom in red. The first one is just a probability of success, a retirement readiness rating. It's a probability of not running short of money in retirement. If you don't run short of money in retirement, that's a successful retirement as far as we're concerned. But it makes a big difference between whether you run short by just a couple bucks or whether you run short by hundreds of thousands of dollars. So the one we're going to focus on today, retirement savings shortfall, I take the present value of deficits for those who run short of money in retirement. How big is that? Last bullet point on this page, if you take the aggregate deficit for all households currently ages 35 to 64, in today's dollars, they'll need an extra $3.8 trillion. So that's our baseline. That's what we're coming at from a starting point in terms of how big the retirement deficit is. And what I'm going to be focusing on in the next couple of slides is to look at how much these different legislative proposals could change that. Very quickly, let's break out that $3.8 trillion into age categories. I have this into 5-year cohorts. It's pretty constant on the baseline, on the blue lines across the ages. But you will see, oh, by the way, baseline, we assume statutory Social Security benefits continue to be paid out as scheduled. If indeed you look at the fact that the trust fund is scheduled to run out in 15 years, if you take a 24% cut of all benefits at that particular time, it makes a relatively big difference for the younger people, not so much for the older individuals. So if you look at that red rectangle of Social Security benefits are paid out as expected, it's just short of $50,000 per person as far as an average deficit, goes up to $57,586 if indeed there is a 24% cut in Social Security benefits. What about future eligibility for defined contribution plans? There's nothing we can do in terms of what's already happened in terms of your defined contribution participation, but in terms of eligibility in the future, what we do is we break out each of these individuals into various years of eligibility, whether or not they take advantage of it. Just this is strictly coverage. And if you look at, again, the red rectangle for the youngest cohort, you see for those people who are unlucky enough never to work for a sponsor of a DC plan from now until the time they retire, on average, they have a deficit of $78,000. If you drop all the way to the bottom of that red rectangle, for those people who are fortunate to basically work all their future years for somebody who sponsors a plan, then I can drop that by about a factor of 5.5 times down to only 14 grand. So that really shows why coverage, why expanding access to retirement plans is so important in terms of looking at future overall retirement income adequacy. Now, as far as the plan or the coverage enhancements, I jammed 4 of them into one, so hopefully this will make sense as I explain it. But for each of these age cohorts, I have 4 different scenarios. Scenario A, I'm going to assume the plans required for all employers except the smallest, basically 10 and under, are being excluded from this. I realize that if we're not going to use the M word, but if you end up doing a plan that you haven't had to do in the past, you might do something like a 401k or a 403b. For the sake of argument, just to get started, I'm assuming any new sponsors come in as an auto IRA. I assume it's a 6% default. I assume it's an escalation to 10%. I'm also assuming for the new plans, there's a 30% opt-out for new eligibles, which is fairly close to what we're seeing right now for Oregon Saves. That might change as some of the waves of smaller employers come in, but at least for the baseline, that's what I'm assuming. So if you look, again, all the way on the left-hand side for that youngest cohort, 35 to 39, scenario A is a blue bar. it's about a 15% reduction in deficits for that age cohort if that happens. Okay, scenario B, the yellow bar is the same thing as A, but instead of escalating to 10, we let it escalate to 15, and basically we get about another 2% reduction in deficits for the youngest cohort. Again, you should, I'm focusing on the youngest cohort because obviously the older you are when this takes effect, the fewer years you have to benefit from this. Option C might come as a little bit of a surprise to you, including part-time employees. Only, again, reduces the deficit by about another 1%, but again, so much of that impact has already been picked up in scenario A that the marginal impact of bringing in part-time employees is relatively small. And then also, as I said, I wanted to look at a full auto portability, and you can see in option D, the green bar for the youngest individuals, that will increase, if we can get rid of leakages, that will increase the deficit reduction by about another 10 percentage points. So crammed into all one chart, the 4 different scenarios, and for each age. Now, very quickly, guaranteed income for life. I have absolutely no idea. You're going to put together an option where people can get up to 50% of their K balances at age 65. How many people are going to take advantage of it? I have absolutely no idea. So instead of trying to do an overall retirement income adequacy number, what I did is do a stylistic scenario in which I'm looking at individuals and seeing how much their retirement deficits will decrease. Probably not a big surprise for those people who put 50% of their K balance into a SPIA at 65. If you die relatively early, that is going to be a negative reduction in deficits because you've taken part of the money you could have lived on otherwise, and in essence you haven't had enough payments from the SPIA to offset that. But by the time you get to age 85 and above, you see positive reductions in the deficit, which by the time you get out to the 95 to 100 on average is about a $3,000 reduction. The most important part of that slide, though, go all the way to the right-hand side, and if you take the average across all simulated ages of death, we end up with a positive of almost $1,000 reduction, $985 on average for individuals who do take advantage of the option that's being discussed, where you take 50% of your K balance and put it into a SPIA. Open MEPs. Again, there's been some very good surveys out. You can end up with probabilities anywhere from 1/3 to 2/3, depending on whose survey you look at, as far as small employers who don't have plans who are likely to take advantage of open MEPs. But again, instead of trying to look at what the overall impacts are going to be on the universe, what I did was to focus instead on individuals who take advantage of the open MEPs. I'm not sure how many that's going to be, but let's just take a look for an individual what that's likely to translate to. This one's a little bit more difficult to understand because what I do is I break it down into quartiles of the distribution of years in the workforce without eligibility for an employer-sponsored retirement plan. So if you're already working every single year in the future for somebody who has an employer-sponsored plan, an open MEP's not going to be doing anything for you because you're already covered, eligible, etc. So basically we split it out to people on the left side, they benefit from an open MEP for a couple of years. People on the right side, they benefit from an open MEP so much that they're in the top 25%. And the bottom line is, if you look at people currently 35 to 39, my youngest age cohort, there is more than a quarter, a 26% reduction in overall deficits from having the open MEPs. So basically you're taking a situation where under the baseline, you did not have coverage in those years. We're now transferring you into an open MEP. You're benefiting from it for those years, and we're able to reduce the deficit by more than 25%. And to finally finish this up quickly, RMDs, again, the way we do the model, whether or not you're forced to take an RMD is not going to make any difference with respect to your probability of a successful retirement. But since so many people were interested in what this was going to do in terms of distributions, I ran from Craig's most recent 2016 IRA database what would happen for those people ages 71 to 100 from increasing either the life expectancy or the start age, or both, as far as what would happen on RMDs. So at the very top row, I'm assuming there's a 5% increase in life expectancy, which is going to, by definition, change how much you're taking out each year. And I'm assuming you're going to increase the start age by 2 years, so from 70.5 to 72.5. In that case, for the total amount of everybody 71 to 100, we have about a 5.5% decrease in IRA distributions for that first year. If you look only at the non-Roth IRAs, we get you up to about 6.5%. Now, obviously, this is a one-time shock to the system. It's going to come back into equilibrium within a couple of years. But as far as worried about what's going to happen during those short-term transition years, I think that gives you a pretty good feel. Again, if you think 5% is not big enough in the life expectancy, I also have 10% on the bottom. And if you think 2 years is too much for the start date, I also have a 1 year in there for you, if you'd like to take a look at that. So before I get the hook, my key takeaways, my aggregate retirement deficits, as we said, everybody 35 to 64, whether or not they currently have a retirement plan, so there's a lot of households that don't, we're talking about a $3.8 trillion deficit in 2019. Unlike other people who have oftentimes said there's going to be a big generational effect, this is relatively constant across age cohorts. Unless Social Security benefits are reduced, then you're going to have a much bigger deficit for the young people. Future years of eligibility for DC plans can decrease the averages by as much as 5.5 times for the youngest cohort, which should be the big takeaway here as far as the need for increasing coverage. As far as plan enhancements, looking at the youngest cohort, expand coverage to all but the smallest employers, I can get the average deficit down by 15. Increasing escalation from 10 to 15 or expanding to part-timers gets me an additional 1 to 2% at the margin. But again, the big impact here is adding full auto portability will reduce the deficits by an additional 10% over and above what we already saw. Guaranteed income for life, I'm excluding the balances less than $5,000. I get an overall decrease in retirement deficits of nearly $1,000 per individual for those who utilize it. Open MEPs, if I look at the youngest cohort who would have had the top quartile in years of not being covered, I can get a 27% decrease in overall retirement deficits. And again, on the RMD modifications, it's a one-time shock, not a big deal as far as retirement income adequacy, but a 10% increase in life expectancy and deferring the start age by 2 years would have decreased the 2016 IRA distributions, had it taken effect in 2016, for those over 70 by about 8.4%. So I thank you very much, and we'll move on to the discussion. I look forward to the questions and answers later on. Thank you.
Jack, thank you. Thank you for getting through so much information so quickly. That was very impressive. I'm going to start. We have a whole host of issues within RISA and the Secure Act that I want to try to get the take of the panel on, and obviously welcome thoughts from the audience as well. So be thinking about questions you might have. I'm going to start with MEPS, something near and dear to my own heart as I'm working on that product as we speak. Clearly, Jack, the data that you showed shows that it can have a significant impact on especially younger workers who are uncovered. And I think one of the things that at least I think about in my perch is that open MEPs are not going to be a panacea for the entire uncovered, right? It's a solution for a part of the market. And that market and the uncovered market is going to evolve over time, and we're seeing that with state-run plans and other proposals. Some people though have raised questions as to whether or not open MEPs would cannibalize other existing savings vehicles, and so both from Bob from a legislative perspective, I'm curious to get your take on the provisions that are in the bill and whether or not there's anything else that's out there that would could help enhance that. And then Amy, your take, just generally pros and cons about MEPS, what the possibilities are. Is this a big nothing, or is this something that could really monumentally change the way that the industry offers retirement savings plans? I know that's a lot, so take whatever you want.
Well, I'll go ahead and start off. When Jack alluded to or made reference to surveys that were out there regarding interest and potential take-up in MEPS, one of those surveys I think you were mentioning was one that was sponsored by Empower. And we saw significant interest in the small employer market among plan sponsors that did not currently sponsor 401k plan, or sorry, employers who did not currently sponsor 401k plans were very interested in the MEP provisions. And as we've seen from data over the years, some of the biggest concerns that these small employers have are the complexity of the administration, the cost of running a plan, and concerns around fiduciary responsibility and liability that they may be incurring. So I think that the open MEP provisions in both RISA and Secure go a long ways to addressing those issues. We have been supporters of both the MEP provisions. They've been around for years. This is not a new concept. We're very, very pleased to see that that Congress is inching closer towards perhaps actually passing these provisions, and hopefully current affairs will not distract them from moving forward. But we're very hopeful to see something in place. Now, as far as how the market develops, I think there are a couple big question marks there. I think probably one of the biggest question marks is the provision under MEPS that the preferred plan provider in the MEP has to take on fiduciary responsibility, has to be named a fiduciary under the open MEP. So we'll be watching very carefully to see how the market develops, given that we're primarily talking about the smaller end of business, smaller employers. That market has traditionally been sold and serviced by the advisor and consultant community. And many of these individuals are already taking on fiduciary responsibilities around investments under 338. The question is, will they want to expand that fiduciary responsibility and take on the administration? So, and then also the question is, how will the financial services industries react? Will they be willing to become a fiduciary under MEP? So I think those are some of the open questions, and if we can get RISA and Secure across the finish line, then I think a lot of firms, many of whom are represented here, will start developing their business models as how they want to address this opportunity.
Okay, well, when I think about MEPS and when I think about open MEPS, I think that there's really kind of two different roads that we can go down. We can go down the road of uncovered employees, and then we can go down the road of employers that already have a plan, but they're small employers and they're looking for higher quality services potentially. They're looking to lower their prices. So it really, there's two different groups I think about when I think about MEPS. And my first thought is always, we need to be really patient in order to see what's going to happen. Whenever we've seen new legislation, whether it's been HSAs, Roths inside of 401ks, it has taken a significant amount of time to get uptake. In particular, because these are small business owners, it will probably take even longer because they're going to have to really go out and do due diligence almost again. It's like re-benchmarking your 401k plan. And so I think that there is truly an opportunity, particularly if we have enough people understanding how an open MEP could help support their small business. I also think that having high quality digital advice is going to be really, really helpful. Folks are looking for an ability to get advice and move the dial, but if you're an open MEP, that means geographically you're in a lot of different areas. And what I like to think about is how does an advisor support that plan, or how does a 401k plan support that. And really what you're going to want to do is you're going to want to have some sort of great online presence that will help the individual. So I think there's lots of possibilities, but in particular, I think we have to really take our time and understand this is going to be a slow-moving vehicle, probably, and we're going to really have to educate people as to how it works. But more services, that's a good thing, certainly for the small and micro small business owner. Figuring out a way to price it appropriately is going to make a difference. So I think that's where we're going to have to start. Certainly time is going to tell us more.
That's great, thank you. And likewise, we've been looking at it in a similar way. I think it's just a matter of we at Fidelity just trying to figure out, where are those markets, right? I mean, traditionally, you're talking about small businesses that have not offered a plan to date. And, Bob, you mentioned some of the reasons why they haven't. I was curious, both of your takes on how this might be distributed to small businesses and sold to small businesses. And really, is this just another one of the alphabet soup of retirement plans that are out there, or how can it be potentially a game changer for a cohort of businesses that to date have not necessarily found enough value in providing a retirement savings plan to make that leap?
So when you ask how would it be distributed, I'm a huge believer in, obviously, face-to-face financial planning. Our expectation is advisors would really have to be engaged and involved in this process. You're going to need an expert to help you understand who is going to fit into your open MEP, how it's going to benefit you best, and that's the education. And that advisor is also going to be able to help you sort of kick the tires around. And that advisor would also be able to help you kick the tires around, how does this plan make sense for me? So I see a lot of engagement with a plan sponsor, with a broker-dealer, in order to understand, does this make sense? People need help with their 401ks, and I think that takes an individual. That's how we see it being distributed.
Okay, thanks.
And I would agree. I mentioned earlier that this marketplace, particularly the smaller employers, has typically been serviced and by the advisor consultant community, and I don't see that changing. I see that those are the entities who have developed the relationships. To your earlier question or earlier comment, is this just one of another set of alphabet soups? I think MEPs are different in one way. We're not trying to create a simplified, different type of savings vehicle. We're trying to develop a way to efficiently and cost-effectively give small employers access to the same type of plans that larger mid-sized employers have. So that's why I feel hopeful that MEPs might go down a different route than, say, the Simples, the SEPs, and some of the other efforts to close the coverage gap.
Yep, and to kind of close that out, I mean, I agree with both of what you said. I think, from an industry perspective, it's going to be impinged upon us to build something that it actually, delivers the value to the small businesses. And I think, while the advisor community clearly is, historically been the way in which small businesses have received these, I think that we need to be thinking broader than that as well, thinking about other distribution channels, whether trade associations that have, typically helped service some of the small businesses through, on a regional level, even thinking about state-run plans and I know we're not supposed to use the M word, but I think as you think about the future, the mandates that could potentially come down on employers to offer retirement savings, I think that you could end up seeing a melding of MEPs and mandates. So I hope that's not a quote that's going to be put somewhere. One final question I have for you on MEPs, and then we'll pivot to some of the other provisions. There has been a lot of talk over the past couple of years up and down about gig workers and the contingent workforce of the future, and different studies that show just how it's going to overtake the economy, and the need to develop, quote unquote, portable benefits for these folks. Clearly, MEPS could potentially fit into that. I'm just curious your take on the need for benefits for this cohort in the future, and just different thoughts on public policy proposals that might be out there.
Well, definitely there is a need. I mean, we see increasing numbers of individuals who are participating in the gig economy, making sure that they have access to, a good, effective workplace type of savings arrangement, I think is very important. That being said, I don't know that the MEP provisions as currently written would necessarily address it. I think there are a number of questions that need to be answered still, and those answers could come from additional legislation or clarification by the Department of Labor and other regulatory agencies. So I think that's still very much an open question.
I'm going to agree with Bob. I think that benefits in general are going to continue to be a bigger and bigger conversation through the next, several decades and beyond. I think we have more to think about when it comes to portability, whether or not it's going to work for MEPS. I guess I'm not sure if it's going to be something that MEPS is going to help or not.
That's fair. We can pivot, and maybe Jack, I'll turn to you initially. One of the other big provisions is a change to the contribution escalation cap in the legislation, which would remove that in certain ways. I'm curious your research on that, your take on that, whether or not that would provide enough incentive to plan sponsors to move their participants up to higher savings levels over time.
Lori and I did a study back in 2010, I believe, and took a look at how much difference that would make in terms of overall success rates. And so as opposed to what I did today where it got kind of combined in with everything else, I think there was and again, when you break it out by income quartile, it makes a huge difference, but I think there was enough positive impact on the taking off the 10% cap and allowing it to go up to 15 that it would catch the plan sponsor's attention, and I think that would definitely be something that a significant portion of them would end up wanting to make that change.
That's great. Thank you.
So I hate to disagree with Jack, but I'm a big believer in just because you can doesn't necessarily mean you should. So in increasing an auto escalation, say from 10 to 15%, I think that takes on a lot of responsibility as a plan administrator or as a plan sponsor. We have got a lot of individuals out there that would absolutely allow that plan contribution to go up and up and up. But when that happens, there is some sort of impact somewhere else in their financial security. And I wonder if the employer is going to feel really confident about understanding whether or not that individual has a lot of debt. That individual might have something else they should be saving for. So I think 10% is a great number. And I'm not against the legislation. I think let's go ahead and do it. But I think that plan sponsor needs to really think about what that is going to do holistically to that individual participant if you continue to ratchet it up to 15%. So I think in certain situations, and particularly for individuals that can afford it, it might make sense. And you do have the opt-out, of course. But in other scenarios, I think that there might be a risk, and that's taking on a lot of responsibility for the plan sponsor.
Well, I would probably tend to agree with Jack and some of his conclusions. And in fact, if you look at the RISA version, they would eliminate the cap altogether, and so just raising it to 15%. And I think there are some definite positives, allowing allowing those rates to ratchet up. And I do understand the argument that individuals may have other commitments, debt that might prove problematic. But as you mentioned, we do have that opt-out provision. I would actually take it one step further. And when you look at the automatic suite, automatic enrollment at whatever your default level is, automatic increase, we've all seen what a powerful tool inertia can be.
Yes.
And how this probably helped move the needle as far as retirement savings more than any other provisions we've seen over the years. I would take it one step further, and I would look at provisions that we see in both the Automatic Retirement Plan Act, where there would be a form of a mandate, and then also in the bill that Senators Portman and Cardin are going to be introducing, where they're doing it more as an encouragement, and that's automatic re-enrollment. I think that automatic re-enrollment is as important a part of the automatic suite as automatic enrollment and as automatic acceleration, because it goes back and it captures those individuals who may have opted out initially based upon their situation, and then provides an opportunity to get them back into the plan. My comment's always been, once a year I'm required to look at my health savings, my health plan, and make decisions regarding what I want. I don't think it's unreasonable to place that same sort of a decision to individuals as they're looking at retirement.
Just 2 quick points. On the automatic re-enrollment, that is something we're going to be modeling. Just didn't have it ready for today. And by the way, if you have any suggestions on other things you'd like to see modeled as part of this forthcoming issue brief, just feel free to send me an email at vanderheide@ebri.org. With respect to Amy's comment, I certainly agree from the standpoint of feasibility in terms of administration, but the 10% oftentimes is going to sound like it's going to be sufficient when you're bringing employees in at a very young age. When you've got mid-career hires who unfortunately may not have had any coverage previously or may have cashed out those amounts, I think having the ability to get those people escalated up to 15% is going to be extremely important.
Thanks, Jack. Bob, your last point about the kind of annual financial checkup of sorts, I think it's a great idea myself, and I couldn't agree more on that. One thing, Jack, and I guess, Amy, this gets to your question about other needs. If there's any way to take a deeper look at certain income cohorts, especially lower income earners, in the need for emergency savings, right? And so that continues to come up and up with our plan sponsor clients in the discussions we've been having. The increased loan usage on 401ks, especially for those who are auto-enrolled at higher levels, and how that might be balanced in the future, I think is another interesting topic to look at. So now I'm going to move from the M word to the A word, annuities. Lifetime income in some of these bills, especially there's an annuity safe harbor for in-plans, and I'm just curious to get your take on that and kind of where things are just, from a demand perspective. Amy, you might have some comments there. I think long both policymakers, industry, others are trying to figure out what is the right, how do we land the plane on lifetime income, and what are the policy solutions that we should be putting forth to help people make sure that they're taking their balance and achieving the lifetime income that they need, recognizing that everybody has Social Security and the like. So just curious your take on that, whether or not there's high demand in plans for in-plan annuity options, lifetime income options, and then, Bob, your take on the legislation as well.
Well, when I think about lifetime income options, the first thing I think is inside of your 401k, I consider that an accumulation vehicle. That's where people feel really good about the fact that I need to save more, I need to save often, and I need a great asset allocation process, and that's where I'm going to build this wealth bucket. And it's a new sort of series of thoughts to start thinking but I also need to create income from that 401k plan. People don't usually think about it that way. When we've seen demand, when it comes to some sort of annuity feature inside of a 401k plan, usually it's the plan sponsor. They want to help. They're concerned about retirement income. They certainly understand longevity issues. They also want people to feel confident retiring and with some form of income that they feel confident about, they're able to retire and we can get new people into the workforce. The problem is it's the sponsor that's more interested than the actual participant. So when we see that feature, the participant is still in the mindset of, I want to save, I want to grow, and they're not thinking as much about either the income or they're not confident enough to say, hey, I'd like to understand this product and really research it and try it on for size. I think that there are some new tools, certainly to take a look at, that could help demonstrate and illustrate how an income feature would work inside of a 401k plan. But right now, we're not seeing that huge demand. You know, it's the idea is, I think, a great idea. Portability is a nice thing to have, but the participant is usually thinking about retirement income. Once they do retire, once they take that money, they move it to an IRA, and now suddenly it's not a one-size product. It's a series of different things coming together, and not necessarily the silver bullet of one product, but several combined in order to make a really effective, tax-efficient drawdown strategy.
I would agree with much of what Amy said. And right now, when I look at lifetime income, when I look at the drawdown, decumulation, whatever you want to call it, to me it's just a natural progression of where we've come with the 401k savings program. These plans started out in the 80s, and you know the thing that we were focused on originally was participation. How do we get people to start saving? Then we turned, as people started getting larger account balances, we started looking at asset allocation. We started to look at how can we help participants make better, wiser decisions when it comes to investing their assets. Now we're at a point where people have participated in these plans for 30, 40 years, and they've accumulated significant account balances. And so naturally, our new focus should be on how do we help make sure that this retirement savings lasts a lifetime. When we talk to congressional offices, when we talk to staff members, it seems like the two topics they're most concerned about, one is coverage. Everybody always wants to talk about coverage. But the second one that's getting more and more interest right now is this whole idea around accumulation. I think the provisions that are in both RESA and SECURE are important. And I would agree with Amy that right now it seems like it's the plan sponsors who are more interested in exploring lifetime income options. And both the portability and the annuity selection safe harbor, I think, are important first steps to alleviating some of the fiduciary concerns that plan sponsors might have. I do think that Congress needs to continue to look at ways to move forward. And I think the next thing that needs to be done is how can we encourage plan participants to make that decision? I mean, I'm going back years now, but Earl Pomeroy had introduced legislation years and years ago that would have provided tax incentives that would have excluded a portion of distributions that were taken in the form of a lifetime income stream from taxation. And recently we've heard some members and some staff express some interest. It's an expensive provision, but it's something that's worth looking at. I think what we're seeing right now is an important first step, but by no means is it the end. There needs to be some continued work.
Great. So I've got one last question for the panel and then open it up for questions from the audience. Bigger picture, longer term, outside of RESA and the SECURE Act, what are some of the other issues that you think might percolate over the next couple of years, obviously recognizing that the political environment will change, what provisions get the most attention? We heard a lot yesterday in the board meeting from some of the employer groups about the importance of missing participants and auto portability, We've talked about financial wellness, lifetime income, even universal basic income, and the potential impact that could have. So I'm just curious your take on, where you think the future might be headed.
Well, there's a number of legislative initiatives there in various forms. We talked a little bit earlier about the Automatic Retirement Plan Act, Chairman Neal's bill, which frankly I think is one of the boldest proposals out there, and in Power we have supported Mr. Neal's efforts, or Chairman Neal's efforts, as I know many have. And the one thing that I've found particularly interesting about Chairman Neal is if you go back to the hearing that was held at Ways and Means in early February, he made a number of references to the importance of the private sector retirement system and how important that was for helping individual workers reach retirement security. And I find that very heartening that he's taken that position. Beyond Mr. Chairman Neal's bill, I also think that we're developing a more holistic approach to retirement savings, and that's including much more than just accumulation of a 401k, your 401k account. We have health savings accounts, and looking at what is the most efficient way to save, and it should include looking at both retirement savings and health savings account. You look at what's been done, proposals that have been introduced by Senator Wyden and picked up by Senators Portman and Cardin on student loans, making it easier for individual or employers to help their employees with student loan debt develop retirement savings. So I think these are all important movements, and I think that as this industry continues to move forward and evolve, we're going to see more of an integration among the various life phases of the individual workers. Individual workers don't break their life up into buckets, and I think to the extent that we can help them pull everything together, we'll be doing service. That's great.
Yeah, that's actually exactly how I think about it. I think our next step as an industry is truly focused on holistic financial health. And you hear those buzzwords a lot right now in the industry. Health and wellness, the wellness of your retirement plan. But it's not just one piece. It's many pieces of the puzzle. Do you feel confident that you're going to be able to send your kids to college? Do you feel good about your debt-to-income ratio? Do you feel right about how much you're saving? And do you feel on track? A lot of people, they might be saving 3, 5, 15% inside of their 401k. They still don't know what the magic number is. And so the more we can do to help people really feel like that package is complete, it's easy to understand, it's in one place, and they can see it, I think the better off folks will be. I was just at a conference last week, and they said the number one stress of anyone, the first thing that they say is money. That's the one thing that people worry about, and the more we can do to help people feel confident that they're saving the right way, the right dollar amount, the better. There are so many ways, whether you save in a pre-tax situation, a post-tax situation, tax deferred. We really want to help people understand how that tax control triangle could help them move in the right direction, and then at some point how taking dollars out of those accounts is also going to help.
Great. Okay.
I'm willing to predict 1,000 life paths 65 years in the future. I'm not willing to predict what Congress is going to do, however, next year. I would like to, though, add, because oftentimes this is one of the questions I get after this presentation is, so we're showing how to decrease, 27% of the retirement deficits for the young individuals, given these various legislative proposals. What about the other portion of that? Where's that coming from? And every time we do this, it's the long-term care costs, the catastrophic long-term care costs that dominate this. I did a study with MetLife in 2005 that try to break this out as far as cost-benefit analysis. And for the second and third income quartiles, there was nothing more powerful from a risk management decision-making process at retirement age in terms of increasing retirement income adequacy than getting long-term care insurance. I know of no proposals out there right now that are necessarily feasible, but if you're looking for ways of attacking those remaining residuals on the retirement deficits, I think treatment of that would be of utmost priority.
Thanks, Jack. So, any questions from the audience? Don't be shy.
Her first. Go ahead.
Okay. You can get in line.
I'm not the lily white of winter.
Good morning. Anna Rappaport. I have 3 questions to ask you about. The first one is that if people claim Social Security at 70, they get about 75% more monthly income than if they claim at 62. And I find it extraordinarily distressing, not only that many people claim early, but how many of those people claimed early without checking out and evaluating the situation. I'm interested in comments both about getting people to do a better job of evaluating, but also whether you think the whole retirement age issue might be addressed, particularly since as we're living longer, the issues of longer work are becoming more important to people, but policy has not supported longer work. Lots of people are trying to do it. So I'm interested if you see any focus on that. I think it's so important, and it's just a can where we're not even visibly kicking it down the road. We're putting it in a closet. And my other issue, Jack mentioned long-term care, but disability before retirement is a huge issue. I grew up in the era when retirement plans had disability embedded in them. As we shifted to D.C., we just threw that out the window and forgot about it. I'm wondering about that as well. I think those are 3 issues that are also critical to our longer-term thinking.
Sure. I'm happy to tackle just the longer work issue, and this is something, not necessarily from a public policy proposal, but that I've seen, but I think we've discussed it internally, which gets back to the gig workers, right, and worker classification. And I think one of the things that employers face, oftentimes they want to be able to have the skills of older workers there, but there is a cost to older workers, and there's a culture in certain cases of needing workers to move on, and if there's a potential to revisit what it might be, and a partial retirement, right, of sorts. As you point out too, people are living longer. They don't necessarily, the traditional retirement and working into retirement and finding other work is a core piece of happiness for many people. And so I think, I totally agree with you. I think that needs to be addressed, and I think that one way you could do that would be looking holistically at worker classification in the future and where that lands. I'll defer to others on the other topics.
Well, thank you very much for the question. I actually thought about the required minimum distribution date changing yesterday when I was listening to you talk about your history, Anna. So I'm glad that we get to address it here. I absolutely agree that we have too many people taking their Social Security too soon. And as a rule of thumb, behavioral finance says that when you tell people they can take it, they do, no matter how much education as an industry we go out and give. And then on the flip side, when you tell people you are, the required minimum distribution, you have to take it, people fight you on it. They don't want that required minimum distribution at 70.5. So it's a really interesting thing that we think about. The first one is we do everything in our power when it comes to financial planning to make sure people understand the trade-off of starting to take their Social Security early or at the age of 62. One of the things that I looked up for this meeting was in 1962, when the first required minimum distribution was set up, it was set up at 70.5 years of age, and to your point, life expectancy has changed since 1962. At that time, 70 and a half was the RMD. Your life expectancy was just a hair under 70 and a half. 70.1 was the life expectancy in 1962. Now, today, life expectancy, if you live till you're 65, for a man is 84, for a woman is 87. This is a huge difference. So the idea that we are talking about moving the required beginning date to 72, I think is helpful. I think it makes a lot of sense. I'm really, really supportive of it. I like the idea of people having those assets longer and being able to live longer with that, those dollars available to them. But we need to really help support people in understanding what the trade-off is when you take Social Security early.
Okay, thank you. Did you? No, go ahead. No, you go ahead.
I was just going to echo, and as far as the RMD increase, I think that's a good thing. Once again, Senators Portman and Cardin would take it even further. The one thing I would note is that increasing the RMD was probably the most expensive element of the Secure Act. I think it came in at about $9 billion over the 10-year period. But I do still also think that this is an issue that needs to be addressed.
Sorry to interrupt you. So a comment and then a question. The comment is maybe it's rational for people to take Social Security early given the system cliff. The question is actually following from the Lillywhite Award winner, and that is back on the question of managing sort of heterogeneity in retirement dates. From the point of view of a plan sponsor, so what I heard was several comments that were very helpful and interesting about national policy, so RMD dates and Social Security dates, and I heard from the point of view of the individual, right? What about from the point of view of the plan sponsor in managing a workforce? And what I'm thinking about is there's been some very preliminary work. There's a paper by Bob Clark and some colleagues on surveying plan sponsors, and much more interest in trying to manage the workforce to figure out who they should keep, who they should get rid of, how they should manage the fact that the older folks tend to get paid more but want to keep them around. And I don't know that we haven't done a lot of modeling of that, for one thing. Essentially that's from the plan sponsor point of view. And I don't know that we've done a lot of thinking about it. I just wondered what you guys might have to say from the plan sponsor's point of view. Thank you.
I can talk about it a little bit. I think that when it comes to people being in and out of the workforce, we are dealing with an entirely new population. People want to take longer breaks. They want to take breaks during their tenure. They'd like to work more part-time. And I think the idea of benefits that are more portable have a tremendous amount of support because of those workers. We haven't done any modeling. What we see anecdotally, though, is the more flexibility that you give individuals, the more likely they are to remain in the workforce. People want to be able to take a 3-month break. They want to be able to spend a year writing a book, and giving individuals that flexibility or even letting them go to a contractor status, we've seen a lot of success with that.
Yeah, I do think flexibility is one of the keys here, and I'm not aware of any modeling on this as well. But I think there's a recognition that managing retirement date, managing time in the workplace is going to be really dependent upon the type of industry, the type of workplace you're talking about. I mean, if we're talking about a very physically intensive manufacturing job, then that's going to be very different than an office-based job. So I think the key here is giving different types of employers flexibility with the workforce.
We've got time for one last question.
Okay. Yeah, I'd like to talk about lifetime income. It's been discussed and debated for years, and we all appreciate the importance of dealing with longevity risk. On the other hand, the population doesn't seem to have much of an appetite for annuities, and for lots of reasons. In part, maybe they don't appreciate the dollar balance they have is not going to go as far as they think. But it strikes me as also a big cultural issue. We just don't trust institutions. The Democrats tell us not to trust financial institutions. Republicans tell us not to trust government. And you need to trust both if you're going to convert your your account balance into an annuity. Any thoughts about how to deal with those issues, and what do you think going forward we're actually going to address it and get people to embrace that approach?
Wow, there's a lot there.
I'm the moderator, so I can decline this question.
Well, once again, I think it comes down to education. I think that the reason some participants or individuals haven't embraced annuities, particularly within plans, is really some of the inherent complexities in annuities and not really understanding the need to be able to spread their retirement savings out over a lifetime. That's why I mentioned earlier that I think encouraging plans to offer annuities is an important first step, and making plan sponsors feel more comfortable with having annuities as part of their fund lineup is a very important first step. But it's just a first step. There needs to be continued education at the participant level, and then I also think that somewhere or another there needs to be some way to encourage participants to at least consider annuities as part of their solution. And then additionally, I think Amy mentioned this earlier, when talking about advice also needs to make sure that participants get the support and the need and the information they need to do their long-term planning as well.
I want to thank the panel and thank everybody, and hand it back over to Mike.
All right, that was great. So thanks, Andy. Thanks, Jack. Thanks, Bob. Thanks, Amy. Okay, a quick spin. No break yet until after the next one. Now we're going to shift the gears from retirement over to healthcare. I'd like to invite my panelists to come up. We've got John Young, SVP of Consumerism and Engagement at HSA Bank, moderating. We've got Paul Fronston from EBRI as our research director on the healthcare side. We've got Sabrina Davison from Global Benefits at Comcast, where she's the VP, and Jim Brodsky, Senior Client Manager at Cigna. So again, like I mentioned at the beginning, what we've tried to do here is balance some really interesting insights and research-driven content. Paul will walk you through that, and then maybe we'll talk a little bit about pros and cons of different approaches employers are taking to try and help manage the ever-changing and ever-dynamic healthcare costs in the benefits world. So with that, I'll hand it over.
Thank you. Thanks, John. Thank you very much. Let's see here. Get through the... There we are. Well, good morning, everybody. Before I introduce my distinguished panel, just a couple comments from my end. I'm John Young. I'm Senior Vice President of Consumerism and Engagement from HSA Bank. I've been in the consumer-driven healthcare field since the very beginning, and I have to give you some, I guess, preliminary thoughts before I turn it over to these great individuals and their messages today. There's some things in employee benefits that remind me of Prohibition. It started as a well-intentioned idea, to curb violence, crime, and the other ills of the time. What it mostly did, unfortunately, was act as an incubator for the mafia. It was a good idea with unintended bad consequences. And speaking of drinking, what have weddings taught us? Well, the same thing as employee benefits. Open bar, cash bar, people behave differently. You become a better dancer at an open bar. Financial incentives, or the lack thereof, makes a difference. So today, we're going to talk about research around employee behavior related to plan design and where people are in the plan. We're going to hear of an employer's journey, and we're also going to hear from a health plan on what they do to keep people engaged. It's going to be very exciting. I'm going to ask each of my panelists to come up and present on their own here. But first, just a small introduction. Just if you could broaden your self-introduction just before your presentation, that would be wonderful. Just to my left, to your right, is Sabrina Davison. She is the Vice President of Global Benefits for Comcast. How many of you have Comcast? I've been a long-term Comcast member. Yep, I see that hand. Hallelujah. That's awesome. She kind of incorporates the adage, you can take the guy or gal out of Texas, but you can't take the Texas out of the guy or gal. She was brought up in Texas, moved to Manhattan for 20 years, but is back in Texas, and she is got a very important job with Comcast in driving their benefits program. Next to Sabrina is Jim Broski. He's a senior client manager with Cigna Healthcare. And Jim's an avid fly fisher person and is going to be, are you hitting it this weekend? Yes. Yes, you are. And one thing that Jim and I have in common is we've both walked the Camino de Santiago. If you know about that, see us afterwards. And then finally, Dr. Paul Franzen. What can I say about Paul? He's an economist, and he actually gets a few things right. But Paul is one of my favorite people in this industry. He's also very interesting, a big sports fan. He actually touched the Stanley Cup of the 2018 Washington Capitals hockey team. He touched it. I said, Paul, did you kiss it? He said, no, I could have, but I didn't. I don't know about you, but if I'm around the Stanley Cup, I'm smooching that thing, right? Well, Paul is going to be up front, and he is going to be talking to us about some research that I think have implications for all of us in the health and benefits area. Paul, if you would come up. Thank you.
Thanks, John. And just for the record, there were way too many people in line before me kissing the cup who I didn't know. So I guess you asked us to introduce ourselves a little bit more. I direct the health research program at EBRI. And I'm going to share with you some of the research that we have in progress related to plan design and use of healthcare services. So I'm going to share with you two studies. So it's really two presentations. I'm going to go through it relatively quickly. You have the slides. And look for these studies and publications in the future. So the first study is related to HSA balances and use of healthcare services. I assume you're all familiar with, if not this exact slide, what's going on the slide. The percentage of the population in high deductible health plans has been growing, whether it's a plan with or without an account. As of 2018, 46% of the privately insured population in a high deductible health plan, we're basically on the verge of 50%. Keep in mind that the definition here of a high deductible health plan is a definition that goes with HSA eligible health plans, so $1,350 deductible for employee-only coverage. This doesn't include as high deductible health plan enrollees with deductibles of $1,000 or more, which has been typically what we think of as a high deductible health plan. HSAs have only been around 15 years. This is I'd say a relatively strong trend, going from 0 to 21% or so in 15 years. High deductible health plans have been around forever. Though it's only recently, maybe in the last 15, 20 years, that we've been talking about them. I'll admit, some of you already know this, that 26 years ago when I was in graduate school, so 1992, or 27 years ago when I was in graduate school, I was on a health plan with a $1,200 deductible, almost unheard of at the time. So these plans have been around for a while, strong trend towards them, and then there's also the accounts. We're now at the point, as of the end of last year, 25 million accounts, HSAs, in the U.S. So we've done a lot of research. Others have done research related to the impact of the plan, the deductible, on use of services, and you can see all the different aspects that we've looked at and others have looked at. We've looked at plan choice. There's a lot of work done on HSAs, but nobody's really put the two together. And why would you want to put the two together? Well, we know what deductibles do. We know deductibles reduce use of services. We don't know what account balances do. I would think that over time, as people build up account balances, which most people will, because most people don't use a lot of health care, that may change the equation. The question being, do people look at large account balances and at some point use health care services that they wouldn't use if they didn't have the account, if they were only facing the deductible. So do account balances offset the effect of the deductible? Another question we want to ask is whether or not account balances affect choice of health plan. We can't answer that yet. And if anyone has data to help me answer that, I'd welcome the opportunity to do a study on it. But the thinking is, as people build up account balances, are they more likely to go to higher and higher deductibles? They may be, but it's something we can't look at this point. So we know that account balances increase the longer you've had your account. If you look at accounts, this comes from the EBRI HSA database. Accounts opened in 2017, ended the year with a balance of just under $1,100. Accounts opened in 2007, 10 years earlier, ended 2017 with almost $8,400. So you don't want to just look at average account balances and what's happening over time, because there's so many new HSAs each year with low balances that brings down the average. You want to look at these balances by how long people have had the accounts, and clearly, the large balances may affect people's use of services over time when they're looking at these dollars. So we set out to see whether or not this is in fact happening, whether or not account balances, as people accumulate account balances, whether or not it increases use of services. There's information here about our data. I won't go over every bullet, but we've got a sample of about 5,800 people over 4 years where we can match their healthcare claims to their account balances and see what's going on there. What we find with this population is that their balances are increasing. You could see that at the end of 2016. They had people with employee-only coverage had an average balance of just over $2,800, and people with family coverage had an average balance of over $3,300. What I find more interesting is that the percentage of accounts with a zero balance, percentage of accounts that have spent everything and ended 2016 with no money in them, is 2%. Okay, most people are rolling over money. Most people are building up an account balance, despite the fact that they're taking distributions, and the average distribution is increasing each year. We're seeing these balances go up, and more people, almost everyone in this sample, with a balance after a few years. Now, what we have found in general is that the sample, the age, since we're following a population over a number of years, their average age is going up, and as you get older, you use more health care, so naturally we're seeing an increase in use of health care services. What we want to do with our regression analyses is isolate the impact of the account balance from other factors, such as an aging population. And we have a number of outcomes we looked at. I'm going to skip over that, get right to the results. We looked at this a number of different ways. We have two models, and basically the bottom line is we found that increasing account balances result in higher use of emergency department visits, higher use of outpatient office visits, both primary care physician visits and specialist visits. We did not find an impact related to inpatient services. We did not find an impact related to prescription drugs. Okay, so, HSA balances are resulting in higher use of some services, and some other services we looked at. Mixed findings related to whether or not HSA balances increase the use of blood tests, EKG, echocardiogram, and stress tests. But across the board, we find it increases the use of x-rays, CAT scans, mixed results relate to MRI and chiropractic visits, and it increases physical therapy. So I think in some sense what we're finding is that increased balances increase the use of more discretionary services. Less expensive services, certainly not affecting inpatient services, but they're affecting things that you may think twice about. Do I really need this x-ray? Do I really need an MRI? Maybe I should get an x-ray instead of an MRI. Do I really need this blood work? Do I really need to go to physical therapy? And that's where we're finding the most effects. So let me move on to the next study I want to talk about. The impact of deductibles on use of low-valued healthcare services. Note there's one word missing from this title that I want to point out. Anybody know what it is? The word high. Okay. This is not a study about high deductibles. It's a study about deductibles, both low deductibles and high deductibles, with the idea being that we want to know what happens after people reach their deductible. We did test our findings, which I'll show you in a minute, by level of deductible, and found no difference in behavior between people with low deductibles and high deductibles. So we combine them. It's easier to present that. But we want to see is once you hit your deductible, your out-of-pocket spending drops. It may be a $10 or $20 or $50 copayment. It may be 10 or 20% coinsurance, but it's much lower than your deductible. So the question is, do people use more services when they reach their deductible, and are they using more low-valued services? And we'll talk about what a low-valued service is in just a minute. So some information about our sample and the study. We don't, as an economist, one of the last things I want to do is decide what's a low-valued service. We rely on the Choosing Wisely campaign to do that, which provides a comprehensive list, and I'll give you an example of that in a minute. Low-valued services are either harmful or of little clinical benefit. We're looking at 5 low-valued services plus cancer screenings. The 5 low-valued services being imaging for low back pain within 60 days of onset, imaging for an uncomplicated headache within 60 days of onset, pre-op testing for low-risk surgeries, and we use hernia repair as the example. The pre-op testing being a combination of blood work and a chest x-ray. We also look at vitamin D testing and PSA testing. And we study the effect of reaching the deductible and the probability of using these low-valued services. The Choosing Wisely campaign, some background on that, is an initiative the American Board of Internal Medicine Foundation aims to promote conversations between clinicians and patients by helping patients choose care that is supported by evidence, not duplicative, free from harm, and truly necessary. So this is really, it's a campaign between providers and patients. And these are some of the recommendations just for low back pain. I'm not going to go through all 5 low-valued services here, but just for this one, there are 12 recommendations related to low back pain. I've pulled out 3 here, one from the North American Spine Society, the American Academy of Family Physicians, and the American College of Physicians, and they basically all agree on the same recommendation. Don't get imaging for low back pain within the first 6 weeks or so. Okay, that's their recommendation. There are other things you should be doing for low back pain within the first 6 weeks, and if low back pain extends beyond 6 weeks or so, then it may be time to get imaging done. Okay, and you see the same kind of recommendations from the other 9. You see the same kind of recommendations from the other low-valued services we're examining. And basically what we find is that once you reach your deductible, you're more likely to use these low-valued services. Okay, once you reach your deductible, there's an 8% increase in the probability of getting imaging for low back pain within 6 weeks, 28% increase within 120 days, 41% increase in the likelihood of getting imaging for an uncomplicated headache within 6 weeks, 28% increase in the likelihood of getting blood work done before getting your hernia repaired if you've hit your deductible, 73% increase in the probability of getting chest x-rays if you've hit your deductible and you're getting hernia repair, vitamin D testing 68% higher if you've hit your deductible, and PSA testing 21% higher. All of these are statistically significant to different degrees, but across the board with these 5. And it's not like we looked at other low-valued services and only picked out the ones where we found statistical significance. We always, limited our analysis to just these 5. What I also find interesting is we did some work around cancer screenings, breast cancer, cervical cancer, and colorectal cancer screening, because sometimes it's indicated and sometimes it's not. And usually that depends upon the person's age. And I'll just focus on the colorectal cancer screening. For people 50 and older, once they've hit their deductible, they've got a 60% chance of increase in the likelihood of getting colorectal cancer screening at that point, despite the fact that for these people it's free, regardless of when they get it, if it's considered a preventive service. But maybe they don't know. Maybe they think if there's some complication, that may cost them money, so let's wait till I hit the deductible. Whereas if you're under age 50, when it's generally not recommended at all, I think the recommendations may have gone down to age 45, but that wouldn't have affected the years of data we have. the likelihood of getting colorectal cancer screening jumps to 126% if you've hit your deductible. So getting services that are considered low value in a lot of cases at this age, not necessarily for everybody. Family history may play into the decision, but for some of these services, they're considered potentially harmful. Imaging, even though you don't feel it, is an invasive procedure. So key takeaway here: reaching deductibles results in an increase in use of healthcare services that are unneeded, potentially harmful. Keep in mind, what we're really trying to do here is look at, as John started off by talking about, we want more beer, related to we want more healthcare. The unanticipated effects of plan design. We think that we may or may not have it right. I think here we're showing, both in terms of high deductibles and deductibles in general, that we may not have it right. We may need some adjustments. Employers are reacting different ways. We need to engage people before they reach their deductible. We need to engage people after they reach their deductible, and that's what we're going to hear from the next two speakers about. So, thank you.
Good morning, everyone, and thank you, John, for that warm introduction. That was terrific. And a special thank you for the Employee Benefits Research Institute for really providing this forum and allowing us to share our ideas and talk about our expertise. So I look forward to listening to everyone else's presentations today. So what I'm going to talk about at Comcast is how we are focused on transforming the employee experience. More specifically, how we are effectively managing the benefit costs of our plans by looking at that employee experience and making sure that employees have access to, how they're engaging with, and how they're utilizing their benefit programs. So we'll start with our vision. We feel that we can be successful when we can return employees back to their families healthy, if not healthier, than when they started working for us. Contrary to a one-size-fits-all approach, our vision is to really look at the way in which we're building a benefits platform and being able to provide an integrated solution to our employees. We do feel that a seamless, integrated approach is really going to allow our employees and allow the system to really accelerate the ability to provide information to our employees, to allow them to make faster decisions and to drive better outcomes. So a little bit about us. At Comcast, we're big. We seem to be getting bigger each year. For several years now, our healthcare spend has been over $1 billion a year. We cover over 220,000 plan participants, that's employees and their family members, and we are committed to delivering high-value health plans that have low co-pays, yes, low deductibles, and low out-of-pocket maximums. And by high-value health plan, what I'll reference is the most popular plan that our employees enrolled in. Almost 70% of our employees are enrolled in a plan that has an in-network actuarial value of 91%. So for every dollar of healthcare spend, Comcast is picking up on average about 91 cents on the dollar. Our employees obviously like our plans. Employee survey results show that 90% of our employees, actually 92%, deem our plans favorable, if not highly favorable. And so we're really proud about that. So balancing quality and controlling costs can be sometimes easier said than done. We work hard to really manage our costs, and we don't compromise on coverage. We are really focused on making sure that we look at how we're spending money in the plans, how our employees are engaging with our plans. And if something isn't working, we pivot, we recenter, and reset. Over the next several slides, I can share with you how we focus on eliminating waste, how we focused on reinvesting those dollars back into the system. I'll tell you a little bit about the team that's doing all this work at Comcast and tell you how we're measuring our success. And we also do a lot to help share the cost of healthcare benefits across the organization. One strategy that we do use at Comcast is if you're an employee and you receive a higher salary than some of our lower paid employees, you will be asked to pay higher premiums or higher employee contributions to participate in those same medical plans. And I think that too allows us to continue offering a rich benefit plans to our population that maybe other employers don't have the option to do. So putting aside plan design, we'll talk about how we're also focusing on delivering this amazing employee experience. We really want to provide and are focused on providing a very simple but single point of entry into our plans, access into our platform. Again, that seamless integrated approach is going to be very important to us with having all of those support services then sitting behind that single point of entry. Again, I do feel strongly that when you have a system that reacts to the customized needs of our employees, when it can do that effectively, that you really are going to have the ability to have the plans that support react faster to allow employees to make better decisions faster. So as we think about product development, we have a couple of things. We really want to make sure that our employees are using their plans as effectively as possible and that they're getting the most out of our plans. We want our employees to use their benefits. And we look at product strategy in a couple of different ways. We actually partner with several of our strategic vendors to come up with solutions. I've noted too here in the area of health assistance and financial assistance. We've talked a lot about financial well-being earlier this morning, but with our health assistance, we're working with both of these partners to co-develop product, to be able to be a resource for our employees when they have questions, whether it's navigating the healthcare system or they have financial stress, being able to reach out to these assistants and these assistants, being able to provide guidance to them and product. And we don't know exactly what all those products look like, but we're working with these partners strategically to come up and build and co-develop these products together. And we're not afraid to take risks. If we know our employees have a need that can't be met in the marketplace by an existing product or existing service, we're fortunate enough to have the ability to build it. So we're working on that now, especially in the area of financial well-being. And we're not complacent. We're not going to compromise on plan design, and we're not complacent with regards to where we are today. We are constantly reevaluating and reassessing all of our plans, programs, our vendors, our strategic partners, just to make sure that we are extracting and really looking at any efficiencies that we can glean out of the programs. Again, continuing to deliver products that deliver value to our employees and help us manage costs effectively is where our focus is. What is waste? For us, it's very simply unnecessary healthcare spend. That's really important to me and my team. We are tasked with identifying waste, eliminating it, and making strategic recommendations on how we are going to reinvest those dollars back into our programs to leadership. And how this shows up at Comcast is in very, very different ways. Wrong diagnosis, wrong treatment, wrong provider at the wrong place. A couple of examples, I actually was thinking of back surgeries this morning as one example, but that obviously comes into play. The most unfortunate thing is the number of unnecessary back surgeries that are being prescribed today. I think a lot of us are familiar with that. But the lost opportunity for providers to sit back and provide a less invasive approach, such as physical therapy, that to us is a missed opportunity, and unnecessary surgeries is on our waste initiatives with something that we want to tackle. Or something even more egregious. I came across a case the other day in which we had the spouse of one of our employees had his appendix removed because he was having significant abdominal pain, had his appendix removed, and the surgeon came out of the surgery into the waiting room where the spouse was waiting and said, I removed the appendix, so everything's fine there, but you might want to get a colonoscopy, so I saw a little bit of inflammation when I was in there. And sure enough, the spouse went and got his colonoscopy, and a very simple procedure totally alleviated his abdominal pain. That test is waste. That was a significant missed opportunity, not to mention taking the employee away from his family, away from work, and obviously recovery in that process. So that's a great example, too, I think, of not only does waste cost the plan more, but without a doubt, waste is costing our patients more as well. So at Comcast, we have data. We have a lot of data, and we look at that data. It's de-identified population health management data, but that's where we get all of our ideas, and that's how we laser focus on opportunities within our plan. We're fortunate enough on this team to have the insights, to have the intel, to have the processes, to be able to look at that data and reflect on areas of opportunities for us, and again, to make sure employees are getting the most out of their benefits. So it starts with awareness. We do build strategic marketing campaigns out to our employees to make sure that they're getting and accessing the appropriate use of care. We also leverage prevention programs to slow the growth of communicable and chronic diseases. To help lower costs even further, we use SHIELD programs to help augment plan design. An example there would be expert second opinion services, especially if a diagnosis and surgery obviously is involved. And last but not least, plan design and network optimization. We look at those two things as an opportunity to really drive exemplary care at the lowest possible unit costs. So plan design is important, not everything. For sure, we make a lot of plan design changes to help incentivize the ability to use labs as one example, I think came up this morning. So we have $0 copays for preferred labs as one example. But we also use plan design to reinvest back into our programs. A few examples there. Last year, we were laser focused on making sure that cost was not a barrier to behavioral health care. So there are no copays in our plan for in-network behavioral health care, unlimited. And to tie to that, any psychotropic drugs that are tied to those behavioral health care visits, there's no copays for those either. January 1st of this year, another reinvestment back into the plan was being able to lower our copays for certain chronic conditions that are being treated by hypertension, hyperlipidemia, and diabetes, which are three categories for us that we know there's an opportunity to continue to ensure that employees are taking their maintenance medications and their families. So we've eliminated those copays. So I think those are good examples of how we continually extract waste out of the system and reinvest it back into our plans. It takes grit. It takes a lot of grit to manage $1 billion healthcare spend, and we have spent a lot of time thinking about the resources and tools that we need as a leadership team to help with that. So over the past couple of years, probably the last 3 years, we've developed this team we call TRIP. They are a TRIP. They're the Total Rewards Innovation and Product Team, and this team is made up of a whole host of health plan experts. They focus on data and behavioral science. They focus on product design, change acceleration, and employee research. This team really helps us as benefit leaders turn our ideas into actionable solutions. In particular, this team helped us come up with all of our playbooks. So this team has developed our playbooks. They continually manage our playbooks, but they manage our overall playbook portfolio. And for us, what a playbook is kind of a problem statement or an opportunity that we know needs to be addressed. Based on data, based on intel that we've learned and talking to our employees and listening to our employees, most importantly, we come up with playbook opportunities. Underneath each playbook, we identify initiatives or ways in which we can address that playbook. So my playbook, of course, one of them is waste elimination. An opportunity or initiative under that is unnecessary surgeries. Emergency room utilization is another one. And there's all kinds of levers that we can pull, but having all of this in one place helps us as a leadership team make sure that we are laser focused on priorities, and all of us have the same priorities. And so in our team, we don't have pet projects. We don't have projects that aren't tied to our playbooks. Everything that we do is tied to a playbook, and this TRIP team has really helped us make sure that we're focusing on the right priorities. So they've taken our playbook ideas and opportunities and really turned them into prioritized strategic action plans. It really is true, and data is so much power for us, and we use data in a lot of ways. And it allows us to not only analyze data, but also look at where we are present state and have a vision about where it is that we want to be. And we can do this through the playbook exercise. The TRIP team helps us. They even, if we want to build a new product or build a new service, they will actually partner with some of our strategic partners or vendors, and they'll go through workshops, like 2-week sprint workshops, in order to work through what that product or process needs to look like. So again, a big value add to our overall total rewards team. So as I've demonstrated today, we've come a long way, and I'm the first to admit we don't have all the answers by any stretch of the imagination, but we're working really hard. We're very passionate about the work that we do, and I will tell you one thing. We have recognized that without a doubt, when you empower people, and the people for us are our employees who are helping to grow our business, with the assistance and the information they need to engage in their health and benefits, they are making vastly better decisions when it comes to their well-being. Better experiences really drives better outcomes, and our results have proved that. I'll wrap here this morning by sharing our mission. This is our mission. We are not afraid to be disruptive, and we like to push against status quo. Our team is very passionate, and we work really hard to effectively manage the costs of our plans. And one critical way in which we're doing this is by transforming that employee experience. There was an article written about how we are reinventing healthcare at Comcast in the New York Times in August, and I think she summed it up really well in that article and said that we are shedding long-held practices and adopting a do-it-yourself approach. And without a doubt, I think that strategy is working really well for us at Comcast. So thank you.
Good morning, everyone. I'm Jim Brodsky with Cigna Healthcare, and I'll be spending just a few minutes with you this morning. And before I start, I would like to just give you a quick little background. I've been in this business since 1983. It's been a long journey for me, but I've really enjoyed it. I started in the business where, at that time, what did we do in this industry? We delivered a service paying claims. It was pretty simple. How fast you paid them, and what was your quality like, and what network did you deliver to the marketplace at that time as we managed healthcare plans. Certainly a big change has occurred over the years in my career as I've served accounts in the range of 1,000 employees up to about 40,000 employees in my career. And one thing holds true, I know everybody here would probably agree with that the fact is that employee benefits are here to help employers attract and retain employees. So I tried to remember that. It's like the first thing I learned in group school in 1983. And that as a backdrop really leads into my discussion about what you're going to hear from me is about what Cigna's doing. But of course, in the application of it, it really is unique to each individual customer that we serve. And over time, we've seen a transition from serving organizations to serving individuals, okay? From serving a provider or plan sponsor to delivering a service, an engaging service to the customer being the individual. Big transitions occurred, so that's a little bit of a backdrop. So I'll start with a little bit about the environment we're in today, talk a little bit about what we're doing as an approach, talk about some foundational elements that drive everything we do, give you some practical matters about how that plays out, a little bit of a menu, so to speak, in terms of what we do in the marketplace, and then give you some results that I think may be of interest to you to combine with some of the other information you've already gained. So a little bit about the environment. I don't know about you, but if I'm ever doing landscaping, it's good to understand the landscape before you dig, right? Make that phone call. Well, you'll see on these balloons here some of the key stats that we try to keep in mind, and these are just recent, I think, from the last couple of years. The few number of people that drive a lot of cost, 1%, 36% of cost. About 40% of people have a chronic condition. Specialty drugs are taking a bigger and bigger bite out of total healthcare costs, and that's growing. And then from our standpoint, this whole concept of mind and body, the behavioral connection with health, is very, very important to what we do. 20% of the people have a behavioral condition. And those that have a behavioral condition with a healthcare condition spend 2 to 3 times more. And this is played out on all the accounts I serve. I just went through a series of reports for all my accounts, and that's basically a fact. So from our standpoint, we're looking at the whole person, the whole piece of risk. And we know that all of these things drive down to the bottom line of an employer. How's it going to affect their financials, their compensation? How are they going to attract and retain employees? So from our standpoint, a little bit about our approach. We put things all together and advocating for the whole person, because we know that by doing so, we're going to be able to identify risk and handle it in a personal way like nobody else can, because we're bringing all the resources together to do it. So some examples of that on this slide would include things like predicting and saving. What does that have to do with? Well, that's all about analytics, and I'll talk a little bit more about that in a minute. But partnering and championing, you may question, who are we partnering and championing with? Okay? Really, 3 people, three distinct audiences there. First being, of course, our plan sponsors, what their needs are, their unique circumstances and so forth, but also with the healthcare providers that we're working with. And that's been a dramatic change. Instead of us versus them, it's a we. So in fact, today, across our book of business, about 50% of our contracted providers are in an accountable care organization in our networks. That's a big change over the years. So we're partnering with them, and then we're championing the role of the customer in each individual and what we do. So the end game, of course, for us is to attract and retain clients, right, in our world. And to do that, we want to help employees find a balance in what they do, be more productive for their workforce, and do so in an economically feasible manner for our plan sponsors. So let's talk a little bit more about the how. Sorry, John, I got a problem here. Did I click something? Thank you, sir. Some of these themes that you've heard already today are going to flow through this section. So we didn't trade papers or anything, but it's very interesting to me. The backdrop really on what we do on connecting data starts at the highest level of the spectrum of health. Not just physical. You've already heard me talk a little bit about emotional, but social, financial, and environmental. Has it always been this way for Cigna? No, it has not. Actually, if I would have done this slide last year or the year before, we would have talked about physical, emotional, and social. Why has it changed? Because we realize that these other elements have a measurable, the science is behind improving the whole experience of the individual. So our teams are aware, antenna are up, so to speak, in terms of all these factors to give us a view of the organizations we serve so we can deliver a better experience for their people. But more importantly, from our perspective, is really what's under the hood. What's under the hood? Well, we have an engine with powerful analytics. Now, I know our competitors do. They say theirs is good. I say ours is better. And I think particularly because we take an approach to bring in all the elements impacting those we serve. Behavioral, pharmacy, medical, health risk, and so forth, to deliver a better outcome. But more importantly, we do it in such a way that goes beyond simple connectivity. Anybody can bring a lot of data together. The real question is, what do you do with it and how does it make an impact? And for us, really, data is the fuel that drives interactions with those we serve. So think of the constituents. Customer, the individual, the provider, and the plan sponsor. Those interactions that we make with those constituents across all these dimensions, regardless of plan design, okay, so we're not saying only plans with high deductibles, we're going to handle it this way. Those that have a copay a richer plan, a high value plan, we're going to handle it this way. So we're agnostic to plan design because we know all these elements matter. The deployment is really probably the bigger question. So from our standpoint, these level of interactions with real-time data will make an impact in how people use the system, how they interact in preventive care, how they interact with us in chronic coaching, for example, how they use in-network services, how we reduce waste. All those types of things come into play. And I think the reason, I guess the secret sauce from the Cigna standpoint, I would say, gets down to engagement. Because as I've mentioned, we've gone from really delivering a service. I've been with the company 19 years. So even when I started with Cigna, it was paying claims. I heard things like, we're a big company, we can pay claims really well, we got great networks across the country, we're known as not being really flexible and so forth. But in the last few years, really over the last 5, we've changed our viewpoint to deliver a better experience. Why does that matter? Delivering a better experience is going to, I mean experience for the customer, right? Because when it all comes down to it, I'll retain clients, large employers, public entities, and so forth because of trend management, but also because of how their employees feel about their experience with Cigna. Okay, so delivering on that experience. And engaging people is a process over time. I mean, I love my wife, but she didn't, if I would have proposed the first date, she probably would not have said yes. I fell asleep on the first date. She had to know me, get to know me, and to understand me. I think that's a simple example, but the reality is, in our business, the same holds true. We have to help people understand the value we can bring, and we do that through delivering services across the spectrum of some things you'll see on the left side. They'll spend a couple minutes on. Good example would be, of course, evidence-based medicine and things like that, and some changes we've made. We've expanded our evidence-based programs. We're not taking our foot off the pedal. We're doing more. Why? Because there's more data to help support what we do. We're trying to do it better in our interactions with people. We're always using analytics to find them sooner. And I always use the analogy of a metaphor of a net, to find the health risks that we need to deal with. Of course, in the last couple of years, we've expanded to build a wider net with finer mesh. And by doing so, we're delivering more clinical resources earlier to people. Because as we know, with 100% on preventive, everybody gets a preventive exam. Is that right? Everybody gets one. No, stats, even on my largest clients, it's probably 30%, some maybe up to 40%. That leaves 60 that we don't know about the risk. So from our viewpoint, trying to find a way to get more information to help individuals. But I think one of the biggest developments we've had, and I'll skip down to this one a little bit, and then I'll come back, is you'll see a note about data-driven platform. We developed a product over the last few years called One Guide, and it's really a reflection of some insights we gained from national accounts. And why that's important is that we changed the service model to an engagement platform. That not only, it's not a, you ask the question, you get the answer model, to using analytics at the forefront of the experience. So whether it be on the digital asset or the phone, when that call comes in, the participant will be prompted to their 5 top next best healthcare actions. For example, have you thought about, or did you know that you have a prescription that hasn't been refilled? Or did you know that you're eligible for an incentive that will give you $500? Or did you know that there's opportunities for you to use in-network services the next time you seek care? All of that same experience is built on the super analytics that drive also to the site. So results on that, we get more coaching, we get more preventive care, and so forth. And on the right side, you'll see the impact that we're seeing on our most recent platform on health management, which is certainly something you can't, it gives a huge background and a payoff. Oh, I went too fast on that. Did you move that, John? I want to touch on this one because this is an important slide. We did some study, and this will be in your information, about the relationship of MyCigna, that's our data set, on high deductible health plans. So just by having a high deductible health plan and the promotion we do, we're going to get more people registered, more logins, more views, meaning getting them to the resources that can help them. So in our view, across our business, if we can build a relationship as early as possible, we're setting the stage for a better experience, for more plan efficiency, reduced waste, and better trend management. And we've kind of proven that over the years in what we've done. And then in the end, from Cigna's standpoint, by putting it all together, when I mean all together, behavioral, pharmacy, and medical, our results are showing, this is a study that we did, I think we released it last year, for clients that have it all together with us, not all do, all of our clients do, where we're seeing about a $200 per member per year savings on those clients compared to those that don't have integrated pharmacy and behavioral. And it's all because of the experience, driven by the data, bringing those interactions and building an experience for people to engage, make the right decisions, make it easy for them to do the right thing. And for us as a company, it's had a real payoff in terms of what we're doing in terms of reported Wall Street trend. And we're not satisfied. We know that our acquisition of ESI that occurred last year will help further our results for the future. So I thank you for your time, and I look forward to the panel discussion.
I want to invite you to the microphones if you've got questions for this panel. If you don't, I've got several that I can start with. Any questions? Yes, Shan, if you would come to the microphone, please.
Hi. Great information, Shan Fowler. I've had the privilege of working on the partner or vendor side, sitting across the table from the Comcast team, yourself and Sean and the rest of the great team. It's a brilliant approach that you have, and I have kind of a three-part question for both of you. The approach, as I recall it and as you've explained it, is really fantastic because it can be kind of a high touch in the beginning approach and a very sort of assisted approach, as you showed. And as you said, the plan designs don't matter a whole lot because you're getting that touch and you're getting people to get in there. That can really terrify a lot of employers because they hear something like high touch, especially a CFO hears something like high touch and they think high cost. But I'd love to hear you talk about a little bit about how it's actually the opposite. And then along with that kind of approach requires that you have, as you've said, really good partners. And this is a business where partnerships don't always work very well together. So I'd love to hear, like, who are your willing partners? Are are carriers, are they open to this? Are, other people open to this? And then finally, just, obviously you said you have some ventures and you can do, you can kind of release this to the world. Obviously, Haven Health and the whole Amazon, JP Morgan thing, are there plans to kind of release this to the world? Because there are a lot of companies out there that not only don't spend $1 billion, but don't have, the money that they're spending already on this and could really use some solutions.
Okay, I'll start and then I'll let you, Jim, chime in. So thank you for the question. The question's plural. I think that we feel very strongly, you mentioned about allowing employees to make it easy for them to make the right choices, and we also want to say to make it hard to make the wrong choices. So if we can build a system that can react to what the employees' needs are, some employees are not going to want to have a conversation, whereas other employees are going to want to interact digitally in order to get that information. So it's important for us to try to build an integrated, holistic solution that responds to what employees want and when they want it. Everybody's going to be different. We're trying to build a customized solution. We're not there there yet, but we're working on it. And I can tell you one example, an interaction with one of our healthcare concierges can go something like having a phone call and having a conversation about, can you find me the best provider for this service? Or it can be the same outcome of that conversation can happen on the mobile app. When somebody is looking for a provider, even on the other end of that mobile app, they will make the recommendation, oh, you're looking for the nearest urgent care center, are you not feeling well today? To really drive down, is it you or maybe a dependent that you're asking about? Once they find out if it's you, they'll answer your question and say, did you know you have a lower cost option by going to a Minute Clinic, as one example, as opposed to the urgent care center? And it kind of walks you through the process just as if you were having a conversation on the telephone. And again, we're trying to build a solution that the outcome is going to be the same regardless of how employees interact with the system. So I'll let you chime in too.
Just a couple things I would add. I think the thoughts that hit me really come down to reducing barriers for people as early as possible, finding the way that's going to work for them best. A good example could be some clients that we've worked with have started their own clinics that we partner with. We've had clients that may bring in a specialized vendor. It could be for something for in vitro services. It could be for second surgical opinion. Whatever it may be that a client's trying to bring to the table to help, that trigger point in all aspects of their plan, I think you're going to get a better outcome, and it even ties to some pre-diabetic programs. So the other thing that occurred to me is that, you mentioned I was a fly fisherman, you got to keep casting. So we got to use good information to target what we're doing. And I think you get a better payoff by doing that and trying new things.
Thank you.
Great, thanks. Josh Cotton, Brookings. Paul, your work, which is clearly very interesting, I had two questions about it. One is, you pointed out the fact that the deductible affects people's use of, think of them as low value added activities. And so one question is, obviously, does it also affect their use of high value added activities, and does it turn out that people are smart enough to know the difference between high value added and low value added activities, or does it basically just discourage use of theirs? The second question is, you're obviously arguing for the possibility of a conversion to a more reliant on copay model than deductible model, and have you thought through the implications of that, et cetera?
Yeah, so for your first question, as I mentioned, we've done a lot of research. Others have done research on the impact that deductibles have. And so, for example, one of the things we found was that when you move a population with diabetes to a high deductible health plan, they reduce their medication adherence. They're less likely to take the medications that they should be taking. And no employer wants to see something like that. And there are other examples like that. So it does affect use of services that are considered high-valued services. On your question about, have I given thought to alternative plan designs, I have. I think about that a lot. I think about whether or not deductibles are the right plan design. Should we even have deductibles? And when I question that, I'm not questioning whether or not we should have cost sharing. I'm questioning what's the right level of cost sharing. What should it look like? And it might look something like, and I'm not advocating for this, I just think this is a conversation we need to have. Maybe 50% coinsurance is the right answer. I don't know what the right answer is. But I think we need to start thinking outside the box. I like reference pricing because it not just engages the participant, it engages the providers as well. It's not perfect because you will, when you set a reference price, you may see low price providers come up in price. So there are some issues there. But I think we need to start looking at examples like that. You heard a lot. If you think about why we're on the verge of 50% of people in high deductible health plans, it's the easiest thing to do. Right? All you're doing is changing one number. You're not doing all the things that they talked about in addition to that. You don't have to. Maybe you should, but I think we need to start looking at putting everything on the table to really figure out what works, what's the right incentives at the right time. and I think the issue with deductibles, it's a one-size-fits-all plan design that may not work right for everybody in every situation.
Thank you, Paul.
Hi, I'm Sandy McKenzie. These days I'm an economic consultant, and Josh may have stolen my thunder. And Paul, I may have misunderstood your beginning of your presentation because I actually was outside. I'm sorry. I'm Sandy McKenzie. These days I'm an economic consultant, semi-retired. Josh may have stolen my thunder, but I wanted to ask Paul a question. I mean, you charge people more for something, they're going to demand less of it, basically, at a very simple level. And it may be that copays are better than higher deductibles and so forth. But are people always aware when something's low value and something's high value? Do they have the knowledge to be able to distinguish between the two? The second point I'd make, and I hope it isn't just overly personal, but when it comes to colorectal cancer, my paternal grandfather died of it at age 58, 10 years plus younger than I am. My father came down with it, and now my niece, my oldest brother's child, has come down with it. I'm rather big on colorectal cancer screening, regardless exactly of how it's paid for. Thanks.
Yeah, and I'll address that comment first, because in the guidelines, even though there are age appropriate guidelines, exceptions are made for things like family history. And that's why I think our findings are not necessarily perfect, because they're not picking up specific circumstances where it is appropriate to get screenings outside of the age recommendations. So that's something that's not easy to pick up in claims data. On your comment about knowledge between what's low value and what's high value, we're not really distinguishing. We're not really focusing on patient knowledge as much as the financial incentives and how that affects the use of services. So, I don't know if I need a hernia repair. I don't know if I'm going to ask the doctor whether or not I need a chest X-ray in advance. But I think I would. My response may be different depending upon how much it's going to cost me, whether it's a low-value service or high-value service. And that's one of the issues with deductibles. Being a one-size-fits-all, it affects both low-valued services and high-valued services.
Okay, thanks.
Ben Morris with UMB Bank, and thank you for the panel's information. Wondering if anyone can connect the dots between the first panel and the second panel as far as what we're doing for help retirement, as well as then what we're doing with the healthcare side. Thank you.
I'll take a stab at that. I was really listening to several things. I resonated with what Amy was saying about the ability to empower employees and make sure that employees have information that they need in order to make the right choices. I think both of us have a passion towards making sure that if an employee is in a situation where they are worried about money, that is their number one concern. That's exactly why we're building a new resource around financial assistance to help tackle financial stress. We all know, I believe it was referenced earlier too, what financial stress can do on your productivity, on your claims costs. So I think we are connecting the dots there, and I think Amy and I share a similar feeling that you need to be able to provide information to employees as quickly as possible and as easily as possible.
Just to add, digital advice, that's what I heard Amy say. Totally agree with that, and that's evolving. As we get more information, we find different ways to deliver it in a way that's going to, get us the right outcome, give them the right choices, an informed choice, right? And then I think Bob mentioned something about you don't put people into buckets, right? They don't break them their life into buckets, and we don't either. It's where they're at today. They may call us about a concern on a behavioral issue with a dependent child. That's not the time for us to say, we have coaching and you can get $500 incentive. No, we want to help them with where they're at right now, because we earn the right to get to that next step to help them along their way. So that's what I would say.
And I would just add, and I'm getting the hook, do we have time for just one more, maybe? But just before that, just briefly, the HSA is a terrific vehicle to help people for that type of savings long term, because so much of our later in life expenses are health care. What a better product to help people get into and to accumulate money, but a health savings account. Yes, sir.
I'm Stuart Hagan with the Blue Cross Blue Shield Association. I had a question for Sabrina. Impressed with the program that you have at Comcast, and I was wondering if how much that is, do you think, specific to Comcast, or if you were to go to another company of similar size, would you end up implementing a similar program? How much of this is based on the specific characteristics of Comcast? Then I had another follow-up question.
No, that's a great question. I think that over the last 5 years, we have walked into an organization and looked at all of these opportunities. It's a very diverse group of employees. We've got Comcast on the one hand, NBC Universal on the other. Now we've just acquired Sky. So we have a very different set of employee populations that we're trying to solve for. Over the last 5 years, our trend, if you take out all of our reinvestments, has been 1.35%. And I think that's because we started with the low-hanging fruit. We started with the easy stuff. It's getting harder. This is not for the faint of heart. And I think that, again, it's looking at data, and the more that we can build up this internal team that has the expertise to help us mine that data and look for opportunities, the better positions that we're going to be able to react to what that data is telling us, to be able to build services, plan design, or tools in order to solve for any of those opportunities and those gaps.
Okay. And actually, you answered my second question, which was about trends, so that's good. Thank you.
Could you warmly thank the panel? Thank you, everyone. We'll see you back at 11:15.
Panel now, we're going to focus on financial wellness. I'll get that started in a minute, but I do want to reset the rest of the day expectations. We will take a full 1-hour networking lunch, assuming we stay reasonably close to on time here. And then we do have a keynote speaker right after lunch. Mr. Mark Cassidy's here, so we'll have him talk to us about some of that futuristic vision of potential disruption in this space that I mentioned earlier this morning. So, before I hand it off to Craig, I will introduce the panel at a high level. Again, the topic is financial wellness, and it's really a broad look at navigating the financial wellness landscape. Craig will lead and show some data and some research that he's been involved with here at EBRI. And we also have Jeff Tulloch, VP of Group Benefits from PlanSmart at MetLife. Greg Ward, Think Tank Director at Financial Finesse. And we also have Nicholas Holman, who's a Senior Financial Planner with Betterment. So I will step out of the way and let Craig take over. Thanks.
Thank you, Michael. I just want to kind of give you an overview of the landscape of where we're at with financial wellness or financial well-being programs. We can kind of see that there's a lot of people, a lot of entities or companies that are in this landscape or starting out in this landscape, all from retirement providers, financial consulting, insurance carriers, fintech, and then we have single product providers such as student loan providers that provide just products for one specific aspect of the financial wellness world. And how these models or how they provide it and who they provide it through and what to focus on are all different depending upon how they conduct their business. Anything from being fees paid, having margins on the products they sold, who actually engages with the employees, whether it's an investment advisor from a retirement provider, or if it's salaried financial planners who provide some financial counseling, or commissioned agents for single products. And then we can focus on, obviously retirement products. Retirement providers are focusing on retirement. The financial counseling is more broad-based of a full budget. And then obviously the carriers and other benefit providers are generally focused on single items like insurance or a single provider such as a student loan a student loan product that they would take over. So this kind of looks at the world of eligible product. There's a lot of people that are starting to get involved in these products in this space, and they're just starting out, because we as a Financial Wellbeing Research Center came out with a survey last year that kind of looked at what people were doing and what initiatives they're talking about and how they describe the programs kind of on a high-level basis. And we could see that most providers that are either doing it or thinking about doing it are still in the stage of doing pilot programs or periodic campaigns. We're down to only, depending on how you look at this, around 15 to 20% that are doing a holistic program that's really looking at the whole financial well-being aspects out there. Most of them are more targeted in what's going on at this particular time. You can see kind of the benefits that they said they were thinking about providing or are providing, and again, that the overwhelming things are just kind of the single product things, like they're providing a discount, tuition reimbursement. Whereas you get to the more holistic programs, it's very few of the people that have made that step to get to that whole entire area of doing a holistic program for financial well-being. So, before I turn it over to our excellent panel here, they are going to be looking at this in a broader base of kind of even getting about what do we mean by financial well-being, what's included in financial well-being, and what that means for employers and what it means for employees. What are employers looking for, what employees are looking for, and what is actually working that they've seen working so far on these financial well-being programs. So that's where we're going to go to. Again, we'll have questions timed after all of our panelists speak. But for right now, I will turn it over to Jeff Tolick, who will start at the high level of promoting a thriving workforce through financial wellness programs.
Thank you, Craig. So I think my role here is a little bit of the setup guy to warm up the room on the topic of financial wellness, and then I'll hand it over to Greg, who's going to dig into financial wellness at the workplace, to the employer view, if you will, and then I'm really excited to have Nick dig into some content around working with employees. What are the actual needs? What are they asking for? What is the assistance provided? So hopefully, for the three of us, that'll be some useful information. So my comments today will be generally based on our experience with our Plan Smart program. It's a program that's been around for 20 plus years. Probably 3,000 large employers over those 20 years have one component of our program, 7 million-ish employees throughout all those companies. So generally my comments will be based on our experience with the Plan Smart program, but more specifically, I'll delve into some recent research we just published for the 17th annual MetLife Employee Benefits Trend Study. And frankly, every year we do this, it's good data, it's useful information, but frankly, it's MetLife's Employee Benefit Trend Study. So it's written in a way that is admittedly maybe a little bit self-serving each year. I think others might be able to relate to that comment. However, for this year, I feel a little differently. I feel that there's some really great insight that came out of this survey. We interviewed 2,500 decision makers at all size companies, equal number of employees. So I won't go through the Employee Benefit Trend Study in total. You can access that online. There's also a financial wellness supplement to the larger study. If you'd like to see me afterwards, I can give you the actual web address. But the headline of our Employee Benefits Trend Study is, in today's changing world of work, for organizations to thrive, employees must thrive too, right? And within the study, we certainly call out financial stress as the number one stressor. That's no new news to anybody here. But it goes beyond just the financial aspect, and it drills into the workplace and how there's been this work-life blend that I think we can probably all relate to, right? I'm never out of work, right? I'm always connected. I'm always thinking about work, and that causes, stress to all of us, to all the employees. Certainly that has an impact in terms of people showing up to do their best at the workplace. But it goes beyond the financial measures and drills into certainly how the younger population, and maybe more than just the younger population, shows up at work wanting to believe in their employer and have a real belief in the purpose of their employer and applying themselves personally to their job. And from there, the employer can show up as an ally to the employees, recognizing that there is this blend, there is this stress, and thinking beyond just the financial aspects, but for an employer to show up really supporting the employees holistically, using an overused term, but showing up, understanding the employees holistically can really go a long way. So let me drill into this a little bit. Financial wellness has become a top focus for employers. So that is certainly not a new headline, right? I would say for probably everybody in this room and maybe beyond this room, that's old news, right? We know that employers are more and more focused on helping their employees with financial matters. But employers have increasingly become aware that loyalty matters, employee engagement matters, productivity matters. And if financial wellness is such a hot topic, for the employer to continually focus on that can have real benefits in terms of the productivity of the company, the loyalty of the employees, the engagement of the employees. And on the left-hand side of the slide, you can see that in the study, employers admitted that their top benefit objectives are largely centered around financial matters. So you can see the four that are listed on this slide. You can also see on the top right of the slide, employees certainly are asking for, wanting access to financial planning, financial workshops, financial assistance at the workplace. However, only 20% of the employers said they truly offer a financial wellness program today. And I think that's very interesting because, thinking about some of the information that Craig put up on the slide, this is a really broad topic, right? If someone comes to us and says, I want to talk about 401k, or I want to talk about dental insurance, we all know exactly what the conversation's going to be about. When someone says, let's talk financial wellness, you really have to probably ask a lot of questions to narrow down what specifically are you talking about and do you want to delve into. So that's challenging. Employers are trying to figure out what's the best approach for my population today, and that may be different than tomorrow. But then there's also just a myriad of solutions, similar to what Craig put up. There's all these different buckets, if you will, in terms of how MetLife, how Financial Finesse, how Betterment, how others, show up in marketplace. So it can be a bit overwhelming for employers. So interesting dynamic where employers are saying, I really understand the need here, but I'm still trying to figure it out. And I think all of us can help along that line. Financial wellness programs benefit employees and employers. So through the Employee Benefits Trend Study, we substantiated that certain employees say, yeah, I feel like I'm on track with my finances, and you can see that on the slide here. But then the difference from the employees in terms of those that say, yes, I'm on track with my finances, and how I feel satisfied with my job, and loyal to my employer, happy at work, less stressed, less tired. So there is obviously this strong correlation to employees saying, yep, I feel pretty good. I feel right in line with my finances, and how that plays back to the workplace in terms of people being the best at the workplace, being engaged, driving productivity, things like that. And then I'll clear this slide kind of quadrant by quadrant because I think this is a little bit of the aha that came out of our Employee Benefit Trend Study. Employees' financial perceptions don't match reality. So 63% of employees said they feel financially confident, right? So call that 2 out of 3. Yet, number one source of stress is money.
It seems to be kind of conflicting comments, right? That doesn't really make sense. Similarly, over 60% of employees feel they're in control of their finances, but half say, I live paycheck to paycheck. So how can I be in control of my finances and living paycheck to paycheck? And you can see some of the other stats here and the other quadrants. I'll point out this 30%. 30% of those in a defined contributions retirement plan have dipped into it. It's probably, again, not phenomenal news to many of you here in the audience as retirement experts. And then this last stat, 52%. 52% of employees say they expect to postpone retirement due to their financial situation. And that's up from 37% back in 2015. And there was some, for those of you that were at the board meeting yesterday, there was some conversation around people say, yes, I'm going to postpone my retirement, but does that really actually happen? Either based on my ability, my health ability, my ability to find a job, my desire actually to go back to work. So real challenges here, but there's this perception gap between maybe what employees think their situation is and reality. And I think that just the underscored part of that is financial wellness programs can play a big role here, right? So I think I'm in this situation, maybe reality is I'm in that situation, and how we design financial wellness programs and providing different forms of assistance at the workplace can maybe make the reality more clear for people and help them move down a path with whatever their specific financial need is at that point in time. And finally, I'll land on this slide before handing this over to Greg. Very simple formula, very simple slide here. So loyalty is good at the workplace, right? As employers, we want our employees to show up being loyal. If they're loyal, they're going to be committed, they're going to be productive, they're going to be engaged, all things that we want. Many, many studies that demonstrate this. So certainly we want to raise the level of happiness at the workplace while lowering the level of stress. And I'll bring this back to some of my earlier comments around the financial aspect is part of this. Absolutely, if we're trying to drive productivity, engagement, loyalty of employees. But there's other dynamics as well that the employees are increasingly wanting in terms of, does my employer support me holistically? Do they understand that I am an individual and this personal, professional blend is happening? So if we're able to focus on these things that can drive up the happiness of the employees, that kind of by definition would lower the stress and drive the ultimate loyalty and engagement of the employees. So again, a real simple formula maybe to walk away with. And with that, I'll let Greg come up and take it away.
Thank you, Jeff, for that. I appreciate the study that MetLife did. I always enjoy reading the research that's available in the financial wellness space because it tells us oftentimes what we already suspect. So what have we learned about happy employees? Okay, yeah, there's less stress, they're healthier, they're more loyal, they're more productive. I mean, aren't these things that we as employers want? I mean, how many of you are excited about financial wellness? Just as a prospect? Yeah. I was talking to some of you last night, and when I mentioned financial finesse, you were like, oh, I love financial finesse because of the financial wellness and the industry that's emerging. Just to tell you a little bit about financial finesse, you probably already know we were founded in 1999. And basically what we do, Craig mentioned there's some different models to how financial wellness is being distributed. There's kind of single product, there's vendors. We fall into probably that third category. We're a financial wellness provider that works with employers to develop their financial wellness program and then to deploy that program incorporating the different components. And the reason I want you to understand that is all the information that I'm going to share with you today around just how the landscape is shaping up is going to be funneled through that filter. And so with that in mind, I want to take a step back and really just kind of get us all to maybe look at this through a different paradigm. if you kind of think about how today has been set up, we've had our retirement planning session, followed by our healthcare session, followed by financial wellness. And that's been kind of a traditional approach, that you've got this list of benefits for the retirement and the health, and then you've got these other benefits, things like budgeting and debt management and tuition reimbursement, consolidating student loans, pet insurance, you name it. They kind of all get thrown into this third bucket called financial wellness. But I want to kind of change that paradigm a little bit and take that step back, as you can kind of tell what really matters isn't necessarily at the employer level what we're doing, but at the individual level. How is this affecting the person? And that's why we want to put personal well-being in the middle and understand how all of the different forms of wellness, we're talking about financial wellness, there's physical wellness, emotional wellness, spiritual wellness, mindfulness. There were two others that were mentioned from Cigna. Anybody remember what those were? Social, environmental. So there's different ways to understand this idea of wellness, but they all matter at the end of the day because we want happier participants, we want happier employees. So we have to take all of that into perspective. Now, with that being said, the CFPB, I think that's what they're calling themselves today, is that? Okay. CFPB, they kind of put together this definition, and these definitions, we've kind of seen different definitions from different entities. They all have what I would say at least 4 things that are in common. One is understanding what is the current condition of the individual. Is the current financial condition of the individual stable? That's certainly a sign of financial wellness. Are they on track for future goals? That's another important component of financial wellness. Are they experiencing a low level of financial stress? Do they feel like they have control and they have the ability to make choices? And then this fourth one, which I know for Anna this is really important, is are they protecting themselves from the unknown? Sometimes that gets overlooked, but that's an important aspect as well. So when you look at any definition of financial wellness, you're probably going to see at least those 4 things: present, future, low stress and control, and protecting so that I'm able to absorb those shocks, whether it's emergency funds or adequate insurance coverage. Those are all going to fit sort of into that definition of financial wellness. And so kind of with that in mind, let's take a look at how successful employers are developing their program. Now, we know there's a lot of benefits that are out there in the universe, and when you look, for example, Sharon put out research that just kind of put it in these different quadrants that are represented there. But, I mean, you tell me the average large employer has over 60 individual benefits that are available. Sabrina's shaking her head yes, so that means I'm probably right with that number. We are overwhelming our employees with this information. And if we approach this from a traditional perspective, the traditional approach to benefits, let's kind of take that, I think it was mentioned earlier, kind of almost like a one-size-fits-all approach. What is what we think most people need? And then let's go out there and enlist those benefits from those different providers. And then we're going to have all the information about each of these benefits provided to our employees. We're going to give them every year during open enrollment about a 1/4-inch thick benefit guide. We're going to hand it to them. We're going to hope that they read it. And then we're going to expect them to make informed decisions. Does that sound like a traditional approach? This means yes. This means, okay, good. All right. So, yeah, that's kind of that traditional approach. But what I want us to do is I want us to flip that around. So instead of having all the information about the benefits thrust onto the individual, let's start with the individual. Let's get as much information as we can about the individual, and based on the information that we can gather about that individual, let's assist them and guide them in selecting the benefits that make the most sense for them at that moment. You heard Craig mention that a lot of these programs that are emerging are being offered kind of through a campaign or a one-time offering or during a pilot program. But if we want to take this to that holistic level, this needs to be an ongoing benefit. It needs to be something that is engaging and then re-engaging the participants in this process. And so that's why, for the holistic approach, putting that individual in the center and then helping them choose those benefits that are most appropriate for them at that moment. And then as their lives change, so does the benefits that make the most sense for them. So when we look at how these benefits, the financial wellness programs, are being implemented, what we're seeing more and more of is beginning with some type of assessment. We've seen that on the healthcare side with the health assessments. We're seeing more and more of that on the financial side, having these financial wellness assessments. And what is the purpose of the assessment? Somebody tell me, what's the purpose of the assessment? Yeah, we have to identify the gaps. We have to recognize the vulnerabilities. We don't know what we don't know. So we got to help these people identify things that they may not know. And so taking that initial assessment to identify those gaps is one of the values of doing an assessment. What might be another value of doing that initial assessment? How does that help the employer or the plan sponsor? Right. It helps me to understand them better so that I can deliver the benefit better, especially when it comes to education. We might be giving them education on something that they frankly don't care about. Instead, they might be suffering in a particular area where they could really benefit from that education. And then there's one more thing that the assessment's going to help us to do.
Proof is good because you can improve things.
It's a benchmark. It's a benchmark. I need to know if I'm actually getting better, and I need to know by understanding where I am now. So that's the value of the assessment, and then based on that assessment, as we said, we want to help the individuals to then access that information, but we want to make sure that they access the information in a way that they relate to. Some people can do it themselves. We found about 15% of the population, you give them the resources online, they know what to do, and they're going to go out there and do it on their own. The majority of the population, they would prefer some type of human interaction. So whether that's over the phone, whether it's in a group learning environment, whether that's in personal financial coaching one-on-one environment, that's the goal of the assessment, is to help them identify what education they can benefit from and how to receive it best. And ultimately, we want to see, is this being successful? So these are just some of the traditional ways of measuring success. It starts with engagement. When you look at the EBRI survey from last year, engagement was one of the top ways that employers are measuring success. And engagement obviously is very important. You can have the best benefit of the world if nobody uses it. Not very effective. So what are some ways that we can increase engagement in your financial wellness benefit? Well, certainly design matters. And what I mean by that, is it an employer-paid benefit? Is it a benefit that's available to everybody in the organization? Is the financial coaching being made available by salaried financial professionals? That's what we mean by that design element. And with the right design, you're going to encourage that engagement. The culture is extremely important. I just had a question for Sabrina earlier. How many of you work at a place where the kind of health benefits operate in kind of one sphere and the retirement benefits kind of operate in another sphere, and they don't necessarily they fight for the same dollars? And that's kind of that's a common thing, but are there any opportunities to bridge that gap and to take wellness to a higher level so that everybody's kind of working toward the same goal? We talked to a prospect last week or a couple weeks ago where basically they said there was a town hall meeting and the employees asked the CEO a question, and the CEO basically said, well, that's kind of a cost to the company, so we don't really want to do that. How do you think those employees received that comment? We don't want that union management kind of dichotomy there. Instead, does the employer care about the employees? Do you guys think Comcast cares about its employees? Based on what I just saw, absolutely. That's the type of culture we want to kind of elevate. Certainly the communications matters, and champions. We can't say it enough about champions, whether it's local champions. Another client that we had that had extremely high engagement, the CEO did a video that was broadcasting the entire company talking about next Thursday, we're going to shut the company down for 20 minutes so that everyone in the organization can take their financial wellness assessment. How good do you think that engagement was based on that? That that is a champion that I know many of you wish you had. An executive team was that kind of champion about it. And then naturally,
How can you do that in 20 minutes?
a financial wellness assessment? Yeah, our financial wellness assessment, you can do it in about 5 to 7 minutes.
Health assessment?
I don't know about the health assessments. Those are probably more lengthy. So, but it begs the question, do we have champions that are willing to do disruptive things? Think about that. That's disruption at its core. And then lastly, the incentives. Again, I think we kind of recognize the importance of that. The way that incentives we see that works very effective, just incentivizing the right behaviors by giving them wellness credits or putting dollars in their HSA. These are ways that we can certainly increase the engagement. So that's one way to measure the success. Specific metrics. Again, if you look at that EBRI survey on financial well-being, it's no surprise that these 5 items that are listed are the reasons that employers are offering a financial well-being program. So certainly we would want to measure those to see, is there improvement in satisfaction, is there a reduction in debt and reduction in turnover. And then lastly, is behavior actually changing? You can have everybody engaging, but if behaviors do not change, not really an effective program. So just for a couple of minutes, I want to just share with you some research that is being released to the public later this month from Financial Finesse. We looked at 2,458 participants that took a financial wellness assessment in 2013 and then again in 2018 to see how their behaviors changed over that 5-year period. Looking at the various areas, you can see in every single discipline their financial wellness improved, but what was most surprising is the greatest improvement was in the area of retirement preparedness. That was a very pleasant surprise. And so just out of curiosity, we wanted to see, okay, that's over 5 years. Is that any different from 3 years and 1 year? And as you would expect, it certainly was. So there is benefit change, but what we're seeing is that the change in behavior over this population increases with the length of engagement. So not only getting them engaged, but continually getting them engaged over long periods of time. That's where we're seeing the most effective. And again, pointing out this is retirement preparedness as well as investor confidence. And we know investor confidence is really important because what's going to happen with all of the 401k participants when we have the next prolonged correction? What do investors usually do? They panic and they move money, and suddenly that retirement preparedness isn't quite what it was. So we want to make sure we're improving that confidence. This is something that was also really important when we looked at the difference between 2013 and 2018 is we're talking about retirement preparedness, but that didn't just happen by itself in a vacuum. Other things had to improve, and in this case, the behaviors in cash flow and debt management had improved. And then as an improvement in cash and debt management, we also saw there were improvements in contribution rates to the 401k, over about a 50% improvement in 401k contributions and over a 40% improvement in HSA contributions. So you see how improving cash flow and debt management can trickle over into these other areas. That was the one I already showed. And then lastly, just the type of engagement, before I turn it over to Nick, we also wanted to evaluate through a case study, how does the type of engagement influence behavior change? And so we looked at a population from one of our clients, did a case study. About 30% of them are not using the benefit, 30% are taking advantage of financial coaching, the other almost 40% are strictly online. And again, you can see, well, like Lori said, we got to show the visuals, right? We can tell the numbers, but let's look at the visuals. As you can see, there's not a huge difference between non-users and those that are online only. So technology is really important because it helps identify the gaps, but it's not necessarily the most effective at changing behavior. We need to add that additional level. That additional level of financial coaching. And as you can see from the numbers there, the improvements that the financial coaching offered. As there's more engagement with a financial coach, there's actually more improvement in 401k contributions. And then other areas, obviously the slides are provided to you so you can see these numbers. But again, the point that we want to make is that there's value in the repeat usage, and the more we can engage, the more usage we can get, and the more we can channel these participants to the financial coaching,
the more behavior change you're going to see. As behavior changes, a lot of that affects the bottom line cost of the organization. So there's a win-win not only for the individuals but also for the employers that are providing these benefits. So I'm going to turn it over to Nick so that he can share more about the personal financial coaching aspect of financial wellness benefits.
Good morning. Thanks for having me. So I'm honored and proud to represent the robo side of the space today, so hopefully it's interesting to you all. My team and my role at Betterment is not so much on the research side, but more on the client-facing side. So we're the internal certified financial planners that are speaking with clients on a day-in and day-out basis. So that's the perspective that I'll be bringing today. So really in the next 10 minutes, I've got 3 goals that I want to leave you all with. First off, what do employees want to know when it comes to financial wellness? What questions are they asking? And then second, what have we found personally to be very effective at answering and addressing those common questions? And then lastly, I'll run through a quick case study that we have just so we have a benchmark and some data points to back up those first 2 topics. I already got a good intro, so we don't need to talk about that. So first off, what is it that employees want to know? There's really six topics that I've boiled down that seem to pop up day in and day out. And the first is Roth versus traditional. Obviously that applies within the 401k programs themselves, but on a broader perspective, in a world where there's, like we were talking about, an alphabet soup of 401ks, IRAs, Roth, traditional, my spouse has accounts and I have accounts, maybe with different matches and different fees, how do I put that all together into a personalized plan? Second is external accounts, so feeding off that, but more on the investment side. Maybe I know that my 401k is invested correctly, but is there overlap or are there gaps with my external accounts, maybe my old 401ks or my spouse's accounts? How do I get that 360 view of my asset allocation for retirement and for my other goals as well? Debt versus investing. This is a huge topic, especially for younger employees that are dealing with student loans. But surprisingly, it also comes up with our employees that are near retirement when they're starting to think, should I pay off, accelerate my mortgage payoff so that I enter retirement debt-free, or would I be better off investing that into my 401k? It's a really common question that we get. Goal priority. So I think one of the interesting challenges of getting more into the space of comprehensive financial wellness and stepping outside of just retirement readiness is that you get to interact with clients on a much more personal level, and you get to learn about all of their other financial goals outside of just retirement. So in a world where you only have a finite amount of monthly cash flow that you have to deploy to accomplish all of your goals, how do you prioritize that? And where do you make trade-offs or adjustments to fit your budget? Advisor access. So this means a lot of different things to every individual, but how do you engage the participants in a way that makes sense for their current stage of life, their level of financial complexity in their situation, their level of financial literacy, and their account balances? And lastly, fees is always a common point in terms of fees in the 401k administration, fees in the investment choices, and fees in working with an advisor. So I don't think any of these 6 topics are going to be a surprise to anyone here in the room, but these do come up all of the time, and Betterment personally uses it to drive our roadmap in terms of what are we going to be building in the next 6 months, 1 year, 5 years out. And I'd imagine that it should drive all of your guys' roadmap as well in terms of what questions you're trying to address, what problems you're trying to solve. So then on some of those questions, we certainly haven't solved everything yet, but there's a few things that we found to be particularly effective, and I'll highlight a couple that I think Betterment provides a unique way of addressing them. So this is the screen, what we call guided onboarding, that every new 401k participant that has a Betterment-sponsored 401k sees. We get a lot of feedback from HR representatives and new employees alike that starting a new job is a bit overwhelming. there's so many things you have to take care of that it's very easy to let your personal financial wellness, it's one of those things that's important but never urgent, right? And so we wanted to develop an onboarding system that was extremely easy and intuitive for these new employees to enact on. And so there's 4 key things that we've identified that are behaviors that we want every new employee to take and that we allow to do online extremely easy in a few minutes and a few clicks. And those are review your deferral rate, so how much are you saving, especially if there's auto-enrollment, which we highly encourage. Personalize your plan, so the more personalized information you give us, the better advice we can give you in return. So things like, instead of assuming a default retirement age for everyone, tell us what age you plan on retiring, what your living expenses in retirement that you're shooting for, and we can give you better advice. Adding beneficiaries, just in case something happens. And then consider a safety net. And I think this is unique because this steps outside of the 401k plan itself. This is a separate taxable account. But we've seen that, well, one, it's good financial advice. Everyone should have an emergency fund. But we've seen that employees that do have a safety net goal created in their betterment profile, they have less of what we call plan leakage, so less hardship withdrawals from their 401k, less 401k loans, less canceled deferrals when times get rough, because that safety net is there to provide as a buffer. And so that's a huge step if we can get all new employees to do that. Also, on the concept of goal priority, our design team is far better than I am at this stuff, but we make it very easy for customers to tell us as many or as few goals as they're saving for right now. Each goal can have its own time horizon and its own target balance for that. So I want to put a 20% down payment on a house in 5 years, or I want to retire at 65 and spend $70,000 a year. They can input all of those, and then we'll tell them, it might be a little small, but for example, retirement and safety net, they're labeled in green. That means that they're either on track or are already achieved. If we look down here, the dream home goal, it's off track, so it's flashed in red. Now, when it comes back to goal priority, I think that this is set up correctly. I would, as a CFP, recommend that a safety net and retirement are a little bit more important than your dream home. But not everyone takes that step in terms of prioritizing all of their goals. And so if your saving habits don't reflect your personal priorities, there's a mismatch. And that's something that we would want to address or speak with you about. And we've made it extremely easy for the participants to identify that. So I've grouped Roth versus traditional, that question, in with the external accounts because they're linked. You can't really separate those two. But one of the features that I'm most proud about that we offer at Betterment is what we call our How to Save Retirement advice. And so that's on your left side of the screen. We have a retirement planning calculator that tells you that overall target number that you need to be saving each year to be on track for your retirement. But then what we do is we break that out and we rank order which accounts are best for you to save in, so that even if you can't reach that overall savings target, you can at least start with the accounts that are best for your situation. It'll factor in, to answer the Roth versus traditional question, current tax bracket versus expected future bracket in retirement. It'll factor in employer matches. It'll even factor in fees. So it's basically just trying to maximize the after-tax, after-fee balance of each account and then ranks them in that order. It will even factor in non-betterment accounts. So if you tell us that you're married, you sync a spouse's 401k, and you tell us that 401k has a great match, we will tell you to start there before putting $1 into any betterment account, because that's the most efficient use of each dollar for that participant. And then the powerful part, when you bring that all together, we can provide overall allocation advice for your retirement goal as well. So we can see, yes, your 401k is invested properly, but how does that fit in with your overall allocation? Do we need to compensate and go more aggressive or conservative in your 401k to balance out your external accounts? Or maybe we should consolidate some old 401ks or make some adjustments externally as well, so we can have that discussion. And lastly is advisor access. I think one of the unique things about working for an online financial advisor like Betterment is there's many ways that we can interact with the customer, and we've found that increasing the number of ways that participants can engage with us increases overall engagement as a whole. And so some customers, it might be that they don't want to interact with a human, and I won't take that personally. Maybe they're okay with our online tools and our resource center articles. We see a lot of engagement from 401k providers that they want us to come in and do quarterly webinars and educational sessions. And then at the individual participant level, maybe they want to work with an advisor, but they don't need that ongoing relationship. Maybe an hourly planning situation might work better for them. And then, of course, there's the employees that want that unlimited ongoing relationship with a CFP. So all of those options, we're pretty much agnostic about which one you choose. As long as you're getting the advice that you need, we're happy. And so I'll wrap up with a quick overview of a case study just to highlight some of these things that we're talking about. So one of our 401k one of our 401k companies is a great cybersecurity company called WatchGuard. And they were gracious enough to allow us to work with them to get some great data both before they transition their 401k over to Betterment and then immediately after. And so we can measure the impact. And that's a little bit of demographic info about WatchGuard itself, but what we did is we identified 3 key metrics that we thought would have the largest impact on WatchGuard's employees, and we tried to measure those. And we found really incredible results across all 3. So the first is increased participation rate. So just overall, how many employees are actively saving into the plan. Second is, of those employees that are saving, how much are they saving? And those numbers went up as well. And then on the investment side, how many employees are investing according to what we would believe to be an appropriate risk level given their current age and target retirement age. And we saw improvements across the board, mainly due to some smart defaults, as was said earlier on the panel, auto-enrollment, auto-escalation, re-enrollment when, at certain periods, and then QDIAs or default investments. What we did is we quantified the benefit, the expected benefit over each employee's working career, and when we add those 3 metrics up, it totaled over $55 million in added retirement wealth across all of the employees, which is huge. Particularly, the single largest factor by far was just getting more employees saving into the account. And so I can nerd out about complex investment strategies and taxes all day long, but we all know that the single most important thing is just encouraging people to save early, save often, and save more. And so it's no surprise that that was the single driving factor in this calculation. And then lastly, this is a really interesting slide. So this slide is measuring before the transition to the Betterment 401k. It's measuring the deviation away from what we would recommend as an appropriate investment allocation. And so the larger the numbers, plus or minus, the further you get away from zero, means that these employees are strongly deviating away from what we would deem appropriate investment advice. And as you can see, it's pretty much all over the board. There's not a lot of quality investment advice that I would say going on here. Afterwards, this is what it looked like. So much tighter spread. And that's, again, plan design, just interface design, good defaults. And so this was extremely powerful as well. And we know that investor behavior has a huge impact. And so if we can match people to what we believe to be more effective and then communicate that over time and auto-adjust that, decrease the risk as they get older, we think that's going to have a huge impact on investor behavior as well. That's it. Thanks, guys.
Okay, thank you, panelists. Remember, if anyone has some questions, please come up to the microphone and ask. First of all, I wanted to kind of ask, did you drill down to see if there were people of different ages or tenure that were more receptive or more interested in these programs and then were more successful in using them?
Yes, I don't have any of that data offhand, but our average clients are around age 40, and so that's a little bit different than probably a lot of other companies out here. But we see more engagement as employees age, actually. So older people tend to be more engaged on the financial wellness.
As far as the things that we measure, as you would expect, as incomes go up, financial wellness goes up. As people get older, their financial wellness does tend to go up as well. Engagement-wise, it's pretty uniform across the board, just depending on the demographics of the employer itself. But there are some natural improvements in financial wellness just based on kind of the age and income demographics, male-female kind of differences. We still see there's a gender gap in financial wellness, so we certainly would like to see that close as much as possible. So
So those are just some of the things that we've observed in just among the different demographics.
Did you find any specific program that you offered or the way that you offered to be more successful than any of the other programs?
Yeah, I would say, to answer that, Craig, that you have to get to the core of what are we trying to accomplish here. And I think that at the root of it, it's about action. We're trying to change someone's behavior, which is really, really hard, right? We get a lot more joy when we buy a new pair of shoes and we put an extra $100 away a month, right? So change behaviors is like the root of this thing, and we're trying to accomplish. So in terms of the design of the program, I would suggest that there's kind of three core elements to get there. It absolutely starts with education, no question. None of us go through our formative years getting financially educated, right? Maybe mom and dad had a money magazine on the coffee table. I picked it up once. Maybe Uncle Bob had a suggestion for me, right? But none of us had any formal education. And we're a relatively bright species, so if we get educated, we're going to be informed, we're going to be confident. But the education in of itself doesn't get us there because this is about behavior change. So that's a start, continual information, continual education. But I think that in addition to that, it's about access. And I think we all touched on this topic at some point. And the access part is about not the younger population, not the older population. It's about all of us want to access different information differently at different times in our lives based on what the specific thing is that we want to zero in on. So I'll use myself as an example. At the end of last year, my wife and I got a new car. And a typical question is, should I lease it? Should I buy it? So I went online to one of the calculators we have, a very simple calculator, plugged in 3 fields of data, I think, and said, here's the lease outcome, here's the buy outcome. I didn't want to talk to anybody. I knew it was a pretty easy thing for me to evaluate, so I wanted the digital option. I didn't want to go any deeper. Contrast that with, in March, MetLife, we pay out our year-end bonuses. So I got my bonus, and frankly, I was not just going to, put it into an account and hope for the best. So I wanted to talk to somebody. So I called my advisor, Andy, and I said, here's the money. Tell me what's going on in the market and tell you what my needs are, and he helped me invest it. So I think the access part is a second component in terms of we all want things differently for different situations. And then the third, I think, is the real holy grail aspect of this. And Greg, I like that you talked about the CEO video, because the third component is motivation, and that's cultural. And for employers to really be supportive and get behind this so that people have an understanding, wow, my employer really cares about me, and they're willing to provide me these tools. I think it's those 3 things that can really get to a real strong program.
I would just say that it really depends on the client themselves. For example, we work with a mining company that didn't have any access to technology, and if you want to get miners to change behavior, you go to the spouses. So developing that program that incorporates the spouses was really important. And so just recognizing the dynamics of the workforce. If you approach it as, I need to offer financial wellness, so I'm going to check a box, that's not going to work. But if you approach it with understanding the workforce and what the challenges are and adapting the program to those challenges, that's where you're going to increase the effectiveness.
When it comes to engagement, I think it's increasing engagement as much as you can, but also channeling when customers do engage with you, making sure that it's in a positive and beneficial way instead of the opposite. And so we're big on design and behavioral science, excuse me. And so we'll take strategic things like we don't show negative performance in big flashing red like some financial companies do. The only thing that is color coded is, are you still on or off track for your goals? Yeah, the market went down, but you're still on track. So sit tight. Don't shoot yourself in the foot. Just channeling when they do engage with us, making sure that it's constructive.
Sandy McKenzie, I keep turning up like a bad penny, but I wondered if the concept of personal financial or personal responsibility ever came up. And isn't the problem with our society these days that people are almost abdicating it? We get these proposals that a household with an income of $120,000 should get subsidized educational loans when the average taxpayer is paying, I believe, according to the Fed's triennial survey, I think the median household income is $60,000. I realize that certain problems are simply too technical for people to understand, but I really do wonder if you know, the notion of the buck stops here is conveyed in these programs. Not that you should say to people, you know, I mean, you can't tell people, hey, go learn the differential calculus all by yourself. But again, to make the point, does the concept of personal responsibility get a lot of emphasis? Because the buck does ultimately stop with the household and with the person. Thanks.
We think that's one of the main focuses of financial wellness is empowerment. We want to empower the individuals to have the acumen to be able to assess and make decisions that are right for them. One of the benefits for financial coaching is the accountability that comes with the financial coaching. I take phone calls from individuals, and sometimes I'm a financial counselor, sometimes I'm just a personal counselor. If I'm talking about stress in a marriage, that has nothing to do with money. That has to do with the individual, but that's a lot of what that conversation is going to be. So we would agree that our goal is to get that individual, no matter where they are, at a place where they're empowered to be making those decisions, informed, right decisions, and not feeling like they don't have really what's necessary. But the hardest part is then it's the concept of leading a horse to water, not making them drink. We want them to be empowered to make those decisions on their own and to feel that's a responsibility on them. A lot of employees do believe that their employers bear at least some responsibility in making that available to the employees. So,
sorry, Ferry, if you don't mind.
Yeah, no, it's okay.
Sure. But even the very notion of empowerment almost implies a kind of a passive person. He has to be empowered. You don't have to be empowered to say, you know, I am the master of my soul. Mm-hmm. This is my decision. It's not your decision. It's my decision. Sorry.
No, and I think that's where, when I said earlier, there's aspects to it. There's the mindfulness aspect to it, and the spiritual aspect to it. So, if we all agree that everybody's different, everybody's unique, if we go with kind of that cookie cutter approach, we're missing so much. But if we recognize instead that the individual is the most important, we have to be able to provide them with what they need in order to be able to achieve the goals that they've established for themselves. And we can only do so much, but I think that's a good start.
I'm going to chime in. I kind of respectfully disagree, so this will be interesting. I think that personal finances are so extremely complicated that, yes, you do have to take some responsibility, but it would be akin to asking you to perform surgery on yourself to make all of the right decisions. It's just completely unrealistic, and education is part of it. Personally, I've written dozens of educational articles, but even sorting through all of the educational articles on the internet, there's no data that shows that the increase in proliferation of information has led to better investor behavior. So that's why things like plan design, smart defaults, making it as easy as possible for customers to make the right choice is huge. And if we're going to have as big an impact, there's a subset, I think someone said it was 15%, that if you give them the right information, they'll do the right thing. But that's the vast minority of individuals out there.
Hi, very interesting panel, and I have a question, maybe a corollary to what Carrie was talking about. Jeff, on one of your slides it showed that while 80% of employees want financial help, 20% of employers are providing it. And kind of there's this other element that's happening in terms of employer responsibility for employee benefits. We see more of the interest in the gig economy, employers disengaging from employee benefits instead of going the other the direction you're talking about, which is doing a lot more to help people. So can you give me an idea of what do the 20% look like, and what are their characteristics, and how do we get more to be more than 20% to be engaged?
Yeah, it's a really good question. I think the part of the challenge, going back to a comment I made earlier, is what the heck is the definition of a financial wellness program? Right? It's so different for any of us that are polled. So there's no, it's hard to kind of zero in on, okay, this is a like for like, financial wellness program. So I think that's part of what will continually be a challenge for us. But I think the employers that we work with that we feel have a formal program, a robust program. It goes back to, I think, a lot of what we've all talked about is they start with their employers that really genuinely care about the employees, and that's a nuance, right? But they're above and beyond in terms of the culture of the company, how they take care of the companies, just the overall culture. So I think that is one kind of key difference. Again, it's a nuance, but it's a key difference. The second one is the recognition of their specific employee population. I think Greg, just talked about that as well, and being clear. Okay, before we've jumped in, we've done some work to really understand our specific employee, whether it's assessments, surveys, whatever, to understand where their population is, what the needs are. So they've done some homework there. And then the third thing I would suggest gets back to the access component. And that varies based on my last comment. What's the employee population? But ultimately, how do we get information and tools to people that fit for our specific population? So those are just a few things that are differentiated for me. I don't know if you add to that, guys. Spot on.
So great panel by all. I have a question as it relates to plan leakage, namely loans and hardship withdrawals, and that is, have you seen a reduction in loans and hardship withdrawals as a result of the financial education that you've provided to your employees? And I ask because we've done a lot of work over the last few years on education. We have on-site credit unions at a number of our sites, but when I look at the data from 17 to 18 for our under 50K population, the number of hardship withdrawals and loans has increased dramatically. So interested in your findings.
We have seen decreases in requests for loans and hardships from the participants that are engaging in the financial coaching. It also kind of falls back on plan design. We actually have some clients that require their participants to speak with a financial coach as part of the process of requesting a loan. Now, what's interesting from those engagements is you get maybe several different reactions. One reaction is just hostility. It's like, my money, why do I have to talk to somebody about it? And then we become those counselors that are like, hey, hold on here, we're not trying to tell you can't have it. But that, ironically, that's very little. What happens to be a bigger reaction is, I didn't realize my employer offered a financial wellness benefit like this. So it is amazing. There's a stigma that if I'm taking a loan, I'm a bad person. And I don't want to tell anybody why I'm taking this loan. But if they actually can talk to a counselor who is going to connect with them and help them understand this isn't punishment, this is so that we can help identify what's happening. In many cases, they might be using the loan strategically. They might be using it for investment purposes or getting out of high interest debt. But naturally, we don't want them to continue to have high interest debt down the road. So there's that opportunity that's being we increase the engagement, we increase the awareness, we get the right people to the right service so that the likelihood, we're not trying to stop that loan, we're trying to stop the next one. And what we've seen is our recidivism, I think about 10 years ago, Fidelity put out a study, it was about 2 in 3 that would repeat offenders. Our experience has been about 1 in 3 of repeat users, as far as those that engage with a financial coach are less likely to take a loan again. So those are some of the results that we've seen through the structure of the benefit.
All right. Thank everybody for the moment. All right, so we're going to step out to lunch. I believe it's just right down where we had breakfast this morning. Please be back here promptly at 1:15, and at 1:15 we'll hand the reins over to Mark Cassidy. So thank you.
Nice job.
this morning. So maybe a little bit of a food coma starting to set in. It won't last long because this is going to be a very exciting session. So I'm going to get out of the way real quick. You guys already know who I am, but Tom Johnson from the Retirement Clearinghouse had coordinated our next guest and our guest speaker, so I'm going to let Tom do those introductions. So Tom.
Thanks, Michael. Well, it really is a pleasure to introduce our keynote, Mark Cassidy. I've known Mark for, I was trying to figure it out, a long time. But give you just a couple of data points and then get out of the way so Mark can do his thing. A couple of roles that were important and contextual here. He started his career at Northern Trust, was there for 10, 12 years. Went on to Scudder, was responsible for their fund business as well as the 401k business. So he's had the delight of running a 401k business. And then from there, and the role that many of you know Mark most sort of prominently from was LPL. And I had the good fortune to sort of see and be around Mark at the beginning of that process. And really, Mark was the architect that took a couple of fairly cowboy-like broker-dealers and brought them together, turned them into an institutional powerhouse with 16,000 reps, really guided the firm to that position ending in 2017. I think sometime in early 2016 with some friends, a guy Ian Sheridan, who some of you know, created Vestico. And I've had the good fortune to be around and understanding a little bit of what they're doing and thought, boy, if we wanted something to sort of expand our minds, I think this will fit that bill in terms of the fintech world and how they go about identifying companies to invest in. So I'm looking forward to your comments, Mark. Thank you.
Thank you, Tom. I really appreciate it. I don't know how many years we've done each other, but it has been a while. But I find I've now marked time by lack of hair, which is not necessarily the best meter, but that's the only meter I've got. So we'll go from there. So I do want to cover a number of things, and you'll see, unfortunately, a very data-dense presentation, which is really cruel to do to you after lunch. But there's no other way to do it than to be data-intense, so we're gonna do that. I need to set up a little bit before we get to the data, a little more about Vestigo. Then we'll talk about why it's relevant to you in the 401k industry in particular, and benefits more broadly, although this will be heavily towards the retirement space. It's an area that we obviously study, given that we invest in early stage fintech companies. And we'll also talk about it both from the employer standpoint and the employee standpoint as well, because the data gives us good insight there. And we'll talk through a little bit about some of the benefit desires and just give you a little peek into a way we can look at information coming from consumers about benefits they'd like to have. And then I want to give you kind of a future look at how I think fintech's going to really change the incumbent's nature of what they do. And it's best to look at that in the banking industry. Your industry is incredibly well protected, so I was thinking about just sort of words of wisdom that I could impart, one of which is go, phew, thank goodness for the fact that you have a scale business that is incredibly well protected by regulation and by the fine work that you do. Don't get me wrong, but you are particularly well insulated. If you're in the banking industry, you are running very scared right now. And I'll explain why when we get towards the end of that, just to give you a sense of it. It will come here, and I can show you, and we'll show you some competitors that you know, some of whom are in the room, that give you some insight into why they're getting traction and how they're getting traction. So we'll do that together in the time we have, and obviously happy to take questions. So Vestigo Ventures is a $60 million fund founded by Dave Blunden and by me. Dave, you may know through a company called Vestmark, EverQuote, which is a public company, Jobcase, which is LinkedIn for the blue-collar set. And I've known Dave for 15, 20 years, and he has an asset called Kogo Labs that I'm going to show you a bit more about, which is why we wanted to partner together to use the Kogo Labs assets to be able to find companies and also form competitive pictures using the data that he has. We have Ian Sheridan, who many of you know, having also been in the employee benefits industry a good part of his career. One of my favorite sayings of Ian's is that he gets to say wow at least once a day, right? Because he meets really interesting people, sees really interesting ideas. I know I experienced the same thing. And Ian was there at the start as a co-founder with Dave and I. Mike Nugent, you probably don't know, but founded a company called Bison, which is Morningstar for private investments, so a really interesting company, and wanted to get back to basically the area of managing assets, and so joined us about 2 years ago. So that's the team. We closed the fund last summer. This is just a fun picture, so I share it, of the NASDAQ being nice to us, letting the world know that Fund 1 closed. It took us 17 months. I will tell you, I've worked hard in my life. I've never worked as hard as I worked in those 17 months to ask people for money. And I found it funny at the end of a long career at LPL, where I described to people that when they'd say, what's the difference between your old life and your new life? Well, the old life was I sat in office and people came to me to sell me. It was really nice. My new life is I go anywhere, anytime, any place somebody asks me to show up so I can talk to them about the fund and what we're trying to do. So it was quite a change in a pretty short time. But what I wanted to do with what I call Life 2.0 was to basically get out of operating a company and instead see if we couldn't help young startups basically find a way to be successful in fintech at a time in the industry. I've been in the industry 38 years in retail advice, ultra high net worth advice, employee benefit type advice, mutual fund advice. I think we're at a stage where we're going to see tremendous change in the next decade along the scale of what you've seen in other industries that digitize. It will happen very differently in financial services because of the moats, but it's going to happen just as thoroughly as it has in publishing and in music and other industries that have been decimated for a little different reason. This industry will not be decimated, let me just add optimism, but you will have to learn how to partner with these startups, and you'll have to learn how to innovate. Many of you already are doing that well as you look here. So I view myself as an arms dealer, just to be clear as day. I have 15 companies, and I want to make sure that as many people as possible know about those companies, and that we can do that across banks, insurance companies, benefit providers, retail financial advice, because we're at such an exciting time for the technology and for the opportunity for these startups and incumbents to work together. So that was our thesis. The other part of our thesis was that we're only getting started. On the left-hand side of this chart shows you that in consumer goods, there's an enormous amount of venture capital arrayed against the public companies that are there. So roughly almost $8 trillion in venture money going against over $8 trillion of market cap. And look on the right-hand side of that chart. I don't think that what's going to happen is that the $23 trillion of value of financial services is coming down, right? The green bar is going to go up as more and more capital goes to financial services from families, from individuals, from institutional investors who are looking for ways to get returns. And that was our thesis. That green bar is going to go up. And while we're a very small first fund, we'll have a series of funds over time that stay focused on early stage in the fintech space. So just important to understand that trend, because if you look at what that trend has produced so far, robo-advisors, a number of new participant companies in the employee benefits space, lots of new tools for financial advisors, it's just getting started, just at the very beginnings of those stages. So what is Kogo? So I always say at this point, seem like you have nice people at Vestigo, you have a network of contacts and information, you have money, that's good. So far so good on the venture space. But what we have to have that's differentiating is data. And Kogo has 7 petabytes of data. So does anybody want to guess what 7 petabytes is? If you think of the Library of Congress, because we're in DC, I looked up this stat. How many libraries of Congress would 7 petabytes be? Anyone? 220. It's a lot of data, right? So we have as much data as eBay or Spotify would have, and this is a private database completely owned by Dave, used only to launch companies for Link Ventures, or used only for fintech and for Vestigo to discover data. I'm not going to go into the details. We could spend 2 hours on just what this is. But I will tell you that we demoed it probably 220 times, and every person who came out of that demo said, I've never seen anything like this before. What we're doing is we're looking at the search patterns, the email boxes, basically 86% of the U.S. and Canadian population. Now you say to yourself, I thought all that was private. It is not the least bit private, and it is actually quite easy to get, even in Europe, or even with the changes that California has made in terms of data privacy. And there's reasons why. All this data has the personal information pulled out, so I can't see exactly what you're doing on the web, right, because that data isn't there, but I can infer what type of person it is based on the websites they're going to, based on the email traffic that's there. Now, I can't do that. I can only ask for it to be done through very smart data scientists, and there's 160 data scientists who work at Cogo Labs every day. There are other choice of jobs: Facebook, Google, NASA, DARPA, the FBI, the CIA. It's run by Mira Welchuk, who started her career in high school as a what's called a white hat ethical hacker. So she was trying to break into networks to see how strong they were, and so she runs Cogo Labs for Dave and uses the tools that are listed here to discover information and the like. So we're going to use these tools to look into this particular space and see what we discover together. It's always best to explain tools in terms of outcomes. So we're going to start with robo-advice or digital advice, a really exciting category. I have a view of it strategically. We're not going to go into that. We're just going to look at the data that tells us something about a company called Wealthsimple. Just show of hands, how many people have heard of Wealthsimple? Okay, so north of the border, it's a Canadian company basically completely funded by the Power Group that is connected to Putnam and Great West, of course, and a significant amount of funding, $124 million. So that first tool, Apollo, would have found Wealthsimple back in 2016 when it first went viral. The yellow line is telling us that certain individuals in our database are basically market leaders. They find interesting companies first, and then the blue line is telling us the general population, the 86% of Americans or Canadians that are basically looking at this company later. And this would be what's called a very strong signal out of Apollo, telling us that this company has real virality. Something is happening to it that's getting consumers to come and pay attention to it. In 2016, it was really very much organic. It wasn't them buying something or doing something unusual. It was essentially word of mouth that was happening. That's what we're most interested in, is finding that first point that they go viral. And the last two companies that I'll show you in the slide deck that talk about kind of future consumer activity, that we found them when they're going viral at the equivalent of 2016. So we just want to make sure that that's clear. Now later you'll see that signal gets stronger and stronger, but they start doing things. They targeted Super Bowl ad spending. Sounds like a crazy idea, but they actually did it in the markets they wanted to be in, not national, and they did it in a very smart way so their customer acquisition costs are lower, which would explain why they're getting stronger and stronger signals. So it's just a way of thinking about how do I find companies. It's easy to find them when they're spending money like that. It's really hard to find them in the early stage of this in 2016. So that's what's unique about the data. If a company goes viral in the next few hours, Cogo Labs actually can find it and present it to us at Vestigo if it's fintech, or present it to Link Ventures, which is our sister company that is looking at consumer activities on the web that might be finding a job, finding a course, that kind of thing. Now, the next thing we can do using the Minerva tool is we can go onto the website and understand where information is coming from, who's coming onto that website, and we can also look at where that traffic is going. I'm not going to show you that part of it. I just want to illustrate the power of the tool. We did the original study in 2017 as part of our work in terms of refining this tool, and we've updated it obviously for today. A couple of simple things to look at. You can see that Wealthsimple has just more parts of the pie, right? There's more discs that are there. What that actually shows you is it's showing you that they are quite good at figuring out how to get a broad array of leads. So that those multicolored small pies in the left part of the circle are all lead sources for them. It might be a blogger. It might be any number of websites that they see high traffic return from. It might be Facebook. It might be Google. It doesn't really matter what it is. What's important is look at the diversification of that and the number of places that they get that web traffic versus Betterment and Wealthfront, who are really, of course, better known to this audience and better known in general in the U.S. market. But it does tell you that Wealthsimple is doing something different that's driving traffic. The other thing they're doing that's different is the blue part of the circle, which you can see in both Betterment and Wealthfront's case and in Wealthsimple, gets to be bigger, right? So by 2019, Betterment has almost 75% of its traffic coming from one source. that's existing customers, right? So that means I have an account and I'm going onto the website. These patterns you shouldn't see in companies this age. You should see a pattern more like what Wealthsimple looks like, which is still getting lots and lots of growth. And if it's an even earlier stage company, you should see almost nothing that would be coming from existing clients for the obvious reason they're building the business. If you're an incumbent, your chart might be 80% blue, people who already know you coming onto the site. So part of what we're looking for when we evaluate sectors of the market or companies is who seems to be growing and who doesn't seem to be growing and why. So this is just a tool for us to look at that. What I would dig into, if this were relevant to you looking at digital advice, would be what is it that Wealthsimple's doing that I can copy, right? What can I learn from them? There's nothing more flattering than being copied, as we all know. The second thing I'd be looking at is what is it that seems to be driving that behavior of growth? Can we find other evidence of that growth that may be there? Well, one place we can look would be their emails. And this tells you the frequency of emails across those same companies. I'm not going to go into detail because I don't mean to be this cruel at 1:30 in the afternoon. But essentially what I'm just showing you is the power of the tool to discern what's happening in terms of that email traffic and their email behaviors. And what you really want to do is be consistent and find a way to constantly test email ideas and email titles. So we just took this, what you'll see is, of course, a lot of information related to existing accounts that are in the email subject line, but you'll also see what the average rate of response is and what ones seem to be working best. In a study we were doing for a bank, what we found was the most popular, most opened prospective email said, how do you boost your savings, that was sent out right around Halloween. Right? You can't make this up. It sounds corny. I would never personally imagine why I would want to do that in an email, but it turns out to be incredibly effective. And that's what we're trying to find, is why is it effective? What audience is it pulling? How do we grow this business over time? So that's what these tools are designed to do. So now let's turn into this industry. So we kind of whipped our way through digital advice, and now we're going to slow down a little bit and talk about an industry that you know and love. And here what's telling is we look at the left-hand side of the blue chart, and what that tells us is basically who are the incumbents, the top 100 search firms. Many of you in this room, your names are in those search terms, right? Fidelity 401k, Prudential 401k, Wells Fargo 401k. But what this also tells you in the orange bar is that 60% of the traffic that's intended to go to you actually gets hived off to startups, right? So they're pretty good at basically using search optimization and search engine marketing to basically grab those prospective clients who might be coming to your site to learn about a small business plan 401k, or might be trying to look for information about starting any size program on the 401k side. So the left-hand bar is telling us that the incumbents, generally speaking, are big, as you'd expect them to be in search terms, but that 60% of their traffic goes away. On the right-hand side, you can see the search terms are small for a newer entry. They're just not as well known, but they're very good at pulling that traffic in. That's where the traffic's gone for them. The middle bar is actually talking about individual consumers. And what was surprising to both Ian and I, having been in this business for a long, long time, is that consumers are looking for lots of information. We saw that in other charts this morning. That's not a surprise to us. But where they're getting it is a huge surprise. They get it from Reddit, they get it from Medium, they get it from lots of blog sites, some of which are really pretty awful, some of which are quite good. And there's a really high range of quality. So we're not going to break down the individual sites in this case, but what it would say to me if I were a 401k provider or in any of the employee benefit space is don't underestimate the value of the independent voice who's advocating savings ideas or advocating ways to think about savings. They are very much liked by consumers, and they're trusted more than you might want them to be on the site. So I know that we at Scudder back in the day put lots of information on early websites and felt really good about it. What this would tell us is today the consumer is not looking at it, and they're going somewhere else to get it. You might also think about doing an unbranded set of sites that really does a high-quality job of taking the same content that you do today, but putting it out in 100 different ways with 100 different names so that consumers can find it. Why would you do that? Because it would help educate those consumers at the quality and level that you do it. It would also be a way for you to understand traffic and potentially then follow up with those individuals now with your brand and with their awareness of that brand to see if you can help them. So imagine the power of somebody finding a site that looks like a blog site to them, then they get a follow-up email using your SEO and SEM a few days later that says, hey, you must be interested in learning how to save more, or the difference between a Roth and a regular IRA. So there's lots to be done if you're an incumbent in this area of search engine optimization and search engine marketing. So let's just look a little bit closer at those top 25. Again, not surprising that in yellow you have lots of names we know and love, and lots of terms that you'd expect to be in that top 25. What's surprising is look at where the most lands go from that search. Investopedia for Fidelity 401k plan. And so it just tells you that there's a lot going on in companies that are digitally savvy in terms of pulling that traffic away. Now, let's look at those organizations that are providing what I might think of as a digital offering or a newer entrant into the 401k business. Again, names you know. Human Interest is the old Captain 401k, which when we first saw it a couple of years ago, we were surprised. What in the world is a Captain 401k? Turns out they are running a very successful business, intelligently rebranded to Human Interest along the way. But what this shows us is their funding is just helpful to know from our perspective. Are they too far along in their life? When we first did this work with Human Interest, we weren't quite ready to start doing investing at this level or using these tools, but we actually could have invested in Human Interest in its seed round, because that's when we discovered it and started to see the activity occurring. Vestwell we've known for a while, many of you know them as well, and what this tells us is basically how engaged are visitors to their sites and what are they able to do. And you can see through average duration, that's basically minutes on the page, pages per visit. These are intense reviews of information on their sites, which is interesting. We know that the funding is also interesting. Don't underestimate the power of somebody else's money. And so that what they're certainly doing is using that capital to build really interesting platforms for service. So they're using tools like artificial intelligence and machine learning to drive their costs down. So instead of humans processing payroll and processing cash flow and that stuff, they're using technology to do it. They're using it to also do education, using chatbots and other things that allow them to interact as if they're humans in that work, and they're still doing lots of work with human interaction, with participants and with plans. But they're basically coming into it building a very different infrastructure than those of us who are incumbents in the space. Very important to recognize that. Second thing is they're using that capital to do customer acquisition. So there's obviously the ratio is that they have a customer acquisition cost that's lower than the value of the plan that they received. We all would know that, right? You have to make that work. But they're essentially getting plenty of capital to be able to spend an awful lot of money on customer acquisition. That's what we know is true for the robos. It's also true in this space. And why that's important to you as an incumbent is they're not going to go away. And if they have success, and these companies are, they're going to get more funding from the venture industry. Go back to that early chart that showed more flows coming into fintech space. You will be the ones who fund these companies going forward. So they're coming. They're here. You may already be experiencing them to some degree, but they're only going to increase in speed. And the one thing I have learned about the venture industry is that there's definitely a FOMO part of it, right? Fear of missing out. I'm sure you've all heard that term, if not in your home from your teenagers, from others. And venture capitalists play the same game. So if they see success among these entrants, they will look for others they can back that have similar ideas, so they don't want to miss out on those activities. So this is sort of, to me, an early warning sign to watch out for. I'm not going to go into detail here. This is their email rates, very high read rates, over 50%. Again, some of them are administrative in nature, so you'd expect that, but there's also some marketing going on here that's interesting. So if I were running one of these companies, if I invested in one of these companies, and I saw, say I invested in Guideline, just to use an example, which we didn't, but if we did, we might go and look at Bloom and see what have they done well, and how can we replicate that inside the Guideline world. It's all available and transparent to be able to see. Again, these are search terms. This is now them looking to put themselves out in the world of search engine optimization. So we all know about buying keywords on Google, and we know that it has a certain cost to it. And you look for misspellings, you look for funny spacing, you look for all sorts of things that might give you an edge in low-cost customer acquisition. What this tells us, though, I'm just going to point out a couple things, is on Guideline on the right-hand side, they have over 100 different search terms that they're using, and that's unusual. We're only showing you the top 10. You can see Vestwell, who's certainly done very well, only has 4. And that's interesting, right? That's odd. And so it makes you wonder why they aren't more active in using SEO to drive traffic, and what could they learn from Guideline to be a better company and to be more acquisitive. So to you, it would look more like a competitor and a new entrant in the market getting stronger. On the lower left-hand side, human interest, the old Captain 401k, basically they're the ones who are particularly good at redirecting site traffic. So getting above the key name that's been looked at. So Fidelity shows up, but they're actually just above it in the search terms because of the way that they've bought that term, and they're able to then hive off about 70% of the traffic just by themselves. So it's remarkably interesting to see that part of it. These are basically visits that come from any individual looking for information, 4 on the left. The ones on the right essentially are showing us, where do there seem to be more customers, not because it's bad, but because it tells us that there's a business that's growing there. So human interest wouldn't have shown up nearly this high even 18 months ago when we first ran this information for one of our investors and for ourselves, and they basically moved up to the top spot in this last round in which we had information. So something's happening that's growing the business, at least based on the data that we see. We would then need to fundamentally go and research it beyond that. So let's shift to the idea of what is the sort of biggest issue that we can see, particularly among 20-year-olds. It's student loan debt. I've heard it this morning on some of the panels. We all know it. That's not exactly a news flash, I know, for you. But we want to just highlight it for this reason, is that when we're looking at data, and again, we don't know it's individually, Mark Cassidy, who's 24 years old, I wish, but it is an aggregate of people who are in their 20s, and this is their number one search term. When they think about employee benefits or they think about investments, they're actually asking the question, how do I reduce debt? And student loan debt, not surprisingly, is the big issue. So this tells us there's an incredible need for help in student lending. It's part of what led us to invest in a company called Vault. It used to be called Student Loan Genius. And also it's what led us to say to them, why don't you focus on those organizations that are providing record keeping. So Prudential and Vault recently announced their partnership where basically all the plans at Prudential will have access to Vault's capabilities, where they built a system for keeping track of student loans and helping the employer pay down those student loans along with it. So we would see the data before to tell us there's something here that's real. We would have believed it from a thesis standpoint, right? But this is the data that backs it up. And then let's find a company that we think will be able to grow rapidly. And we don't like things that are going B2C because that takes you a long time to build customers. Let's instead go to one that's essentially doing a B2B2C play by building their business through the relationships with record keepers. So many of you have these solutions today. I'd only encourage you that you're going to have more and more of them as part of a healthy employee benefits package. And the final thing we'll look at and then open up for questions, and hopefully, again, haven't flooded you with too much data, is that we use this information, the 7 petabytes of information, to about every month run through websites that are going viral. We can run it more frequently, but so far what we found is we can handle it about once a month in terms of just the time it takes to get through it. And what we're doing is we're taking a package of algorithms. So it can be things called Bayesian trees, right? It can be all sorts of other tools that are basically built into the Kogo Labs data set. And we then have a database that uses keywords to look for fintech companies, to look for companies that are providing 401k benefits, that are providing investment advice, that are telling you recommendations for stocks. So we found 500 537,000 of those in the database in the last run that we have here, or excuse me, 2 runs that we did here. That got us to 1,134, which we mark here as mid-confidence, which means they scored well in, I believe it's 3 different algorithms out of a total of 8. So that's telling us there's something there that we ought to probably take a look at. And this is the point where the machine doesn't work anymore and humans have to take over and actually dig into those 1,134 names and then see it. So we just split it up. I have my 134 from the current run that I'm working on now. In this run, I think I ended up with 30 or 40, and that lets us then go and explore what's going on with that company. There's 2 things that we do. We're looking for a company that both is scoring well in that confidence, is early in that confidence, and hasn't accepted funding yet that has come from venture capitalists. And we found 2. Cushion and Long Game in these 2 batches that are aggregated here. And what's unique about these companies is they are B2C companies, and we found them literally as they were essentially putting out either their beta test. In Cushion's case, they're still in beta. They have 50,000 users who are signed up to basically use their services, and so that's how we found them, is because there's so much activity of individuals signing up for what it is that Cushion offers that they stood out from other companies that were there. So we're able to invest in their seed round, for Cushion, and now are helping them with how they think about growth, and then going from beta to actually launching. And what they do is quite simple. They basically take those awful overdraft charges and automatically refund them for you. How do they do that? Is they use chatbots, and basically no humans do it. They have literally 3 human beings who built this company. They built it on less than $1 million of capital because they can rent the cloud from Amazon, and there's very smart people who built it. And what they're doing is they're basically created a way for not every bank, but for the top 10 banks to automatically go back and say, I object to this charge. Now, many of you are user and Lyft users, I'm sure. You'll know that if you dispute a ride, magically in seconds you get a rebate if they judge it within their algorithms to be an okay rebate. No humans making that decision, you know that. That's the same thing Cushion is doing. It's merely going to the bank and saying, I'm going to present you a set of facts, and the bank is looking at that. In some cases humans are, but in most cases their technology is looking at it, and they're automatically refunding part or all of those overdraft fees. There's over $200 billion of overdraft fees that are charged by U.S. banks to consumers. They're probably not charged to people in this room, right? That's the one thing we have to remember. They're charged, though, to people who are in their 20s, who are in their 30s, or people who have much lower means. And so it's a group that is looking for help. So now Cushion comes along and says, I'll take 20 cents of basically every dollar I save you, and you don't have to do anything other than sign up and connect me to your bank. Can you imagine how good that feels to get $100 back, $500 back? They found $1 million so far with their first launches of the first few thousand of their beta users. And as I said, they'll open up that beta test and go larger and larger. And they'll start with overdraft fees, and they'll move to other areas from there. But 3 people, a couple $1 million in investing. We just have given them a round of about $3 million, but that's to add more engineering capabilities and for them to start building the next capabilities from there. So I just want to impress upon you how easy it is to start a company, how easy it is to build trust with a consumer, even though you don't have a big brand name. So that's going to matter in the banking industry, right? If your bank suddenly gave up a significant amount of its overdraft fees, which are pure profit, to your organization. And then the last one I thought would be interesting is Long Game. And I was going to ask you a question, which is how many users, so we invested them 18 months ago in their seed round. We've now led their A round. We did their A round with Soros, with Franklin Templeton, and a couple of other smaller VC funds like ourselves. And they went in that time from under 100,000 users to over 250,000 users of their services. And what Long Game is merely gamification of savings. If I put more into my linked savings account at Long Game, I get more tokens. The more tokens I get, the more games I can play. The games, give me some reward. Sometimes that's cash. Other times it's more tokens. And it just continues to reinforce the message of the importance of savings. You might not find that interesting. I actually am fascinated by it, unfortunately, so I play the silly thing all the time. But what you'll find is 18 to 24-year-olds, this is incredibly popular. And that's where that growth is coming from, is that demographic. We're going to add a debit card here. So suddenly when I have debit card transactions that come through in addition to the savings account, they just added jars, their way of identifying savings pools for these individuals. Today I noticed that they had a side up for giving flowers to mom, which I thought was pretty smart, right, where they can just make it super easy to click and take some money out of that account that I have there and send flowers away to whoever I need to. So they're just trying to find an easier way to interact with you on essentially what are banking services. I think that if somebody's 22, 23, 24 years old, and this is the way they're introduced to banking, I don't really see them going back to banking the way we see it, right? And we don't think of banks the way we used to. I can remember going into a bank. When was the last time, I'll just ask show of hands, in the last month, have any of you been in a bank branch? Okay, that's higher than most populations, right? That's probably about 10%, which would make sense given our demographics. Let's just be honest with ourselves, right? We have to go. Sometimes they're big checks, that's a reason, right? But sometimes you just have to get to the bank. And I don't know if you've seen the Bain study, but bank branch delivery, or bank branch visits in the last 2 years have dropped by over 60%. Why is that? It's odd that it would be that fast, but it's not odd if you know the banking industry. The banking industry is this canary in the coal mine because it's actually going after millennials, right? Whereas our businesses are really after baby boomers, and although you serve the entire population of consumers in an employee benefit plan, you're really working with a decision maker at the employer, right, who's in our demographic. So it's very different, but they are living in the new world, banks. And what they're finding is millennials do not go to branches. They might like your brand, but their brand decision isn't the main reason that you choose somebody. It's convenience, and it's the online experience that you have with that organization. So now if Long Game comes along and teaches that consumer a fun and easy way to do their banking, I just don't see how somebody goes back and says, no, I'd really like to have that JP Morgan account now, thanks, right? You might if you're a certain demographic for wealth, but you're not going to if you're used to that kind of customer experience that's fun and engaging. And so this is an interesting company. Who knows what its future is? But what we're trying to bet on is that there's something in there will start to drive more and more demand from consumers, and I think it's a good lesson to think about how that might impact the way we think about benefits and ways we might want to interface or work with consumers in a different way. So I'm going to stop there, and I think we have all of 1 minute, but see if there's any questions. And again, I apologize for the data dump.
Mark, Joshua Deitch at T. Rowe Price. So one of the things that occurs to me is, our business, we're vertically integrated. We own the storefront, we own the middle office or the plumbing, and we own the back office. And you've given us some examples of companies that are kind of forging their way alongside us. Mm-hmm. But it occurs to me that there could be companies thinking about what we do and simply looking to disintermediate us. Mm-hmm. Because we're basically paid the freight on the infrastructure, and they can add the value on the front end. Mm-hmm. By connecting many of us. Maybe you could talk about that a little bit.
Yeah, I think that's completely right, is that you would have, generally speaking, our view as to why there'll be more B2B success than B2C is because it's still hard to convince a consumer to make a considered decision around investing or savings. We know that's a considered purchase. It's not the same as getting a car out front, right, which is about, did I save money and could I find one, and convenience. And so that's part of the reason why we think B2B is very strong. But there's no doubt that some of the ones we listed that are in the 401k business specifically are absolutely trying to displace you in a B2B world. And there's no doubt that Long Game will be able to displace a certain sector from the banking community that's there along the way. So, and I think what you have to really be careful about and where you need to spend time and energy as an organization, when we think about innovation, you're running, I know, a really good innovation center, is what are the new tools? Is our organization familiar with those tools? Do we really understand data science? Do we really understand artificial intelligence? Do we really understand machine learning? What we know, blockchain sounds sexy and sounds like fun, but what is it really, right? And how do I use it or don't use it? Because that really allows the organization to learn something new in those tools, and that's really all these startups are doing, is they're taking the newest tool, which by definition is more efficient, and applying it to an old problem, saving for retirement, and they're able to do it much more efficiently. And then their pricing strategy is to really undercut you as an incumbent if they're coming directly for the business. Again, you have a lot of moats, particularly in this employee benefits business, but in many businesses the moats are not very deep, and it's easy to come around. Plus, if you're in the banking world, if I can use that example, or even in not so much insurance, we haven't seen it, is it's tempting to break out away and not be the retail bank any longer, but instead to be the wholesale bank. There's a bank in New Jersey that all all they do is empower firms like LongGame. There's a bank in New York City that does the same. So you're starting to see the emergence of, those who are wholesale banks to rent the infrastructure to these startups, and I'm certain you will see it in insurance land. You just haven't quite seen it yet. And I believe you'll see it in other aspects like employee benefits as well, because it'll be a thriving market for someone to say, hey, what I'm going to do is get out of all that work and just be the back end and let other people be the front end of the business. All right. Thank you very much. Lori?
Okay. Thank you, Mark. That was great. We're coming close to the close here. I would make a couple of comments, and then I think Lori wants to officially shut us down. So thank you all for coming. This was great. I've sensed a lot of energy today. I think we covered a lot of ground. In some cases, I joked with Jack, we probably covered too much too fast because there's so much good research, and just trying to find those key points sometimes can leave you wanting for more, but that's kind of by design how we hope you will leave here today. You've left. There's a lot of depth that we didn't have a chance to get to, but there's a lot more time that we've got in front of us where we can do that. So thank you all for coming. I also want to thank the EBRI squad and all of the Public Policy Advisory Council team members, including Tom, that helped pull all this together. There's a lot of work that goes on behind the scenes. Hopefully it worked out well for you and you benefited from it from a knowledge and an insight standpoint. There will be a survey that comes out, so please do. Those are used, as you guys all know, to kind of steer the ship and focus on what we'll talk about next time, how we'll talk about it, what the environment looks like, all that great stuff. So at this point, I think I'll hand it over to Lori to close it down.
I just wanted to add my thanks and appreciation for all that we've seen today. I kind of wish we started off saying we should have a drinking game when the word holistic came up. We should all just take a shot of coffee or something like that. It really proves that there's a lot of integration between all the benefits going on, and we at EBRI are looking into this with a lot of our research, which you will see in coming months. I did learn a couple of new things, and some things were reinforced. What was reinforced is that people don't break down their financial lives into buckets. It's, we all know that, but we need to get more integration. Some people don't like to interact with human beings for financial well-being. The part I liked about that quote was, but we don't take it personally, so I thought that was interesting. New things I learned, benefits can be like the prohibition era. I thought that was a unique insight. And my new favorite, FOMA, fear of missing out. And we're all here so we didn't miss out. Thank you again for joining us, and we will have the recording of this online very shortly, and please do look for the evaluations. Thank you again. We appreciate you.